Hello, everybody. Welcome to this special English power batch for CA Final Indirect Taxes and International Taxation. Hope you all are doing really well. I will wait for 10 seconds for all of you to reply from whole of your heart. How was yesterday's session? Even though I cannot hear you, I can feel your voices. See, I am waiting for your response and then we shall proceed with our topic. Till now, what we have studied, just let us go through it. Give me a second. See. In the chapter capital gain, we started off with the definitions. First definition we studied about capital asset, where we studied all the assets are capital assets, securities held by FIIs or ULIPs. Then we studied about transfers or any kind of sale, exchange, relinquishment, extinguishment, or any kind of using immovable property or redemption of zero coupon bond. And based on this definition, we came up different aspects of transfer, whereas we found out that buyback, slum sale, these all things were also transfer. We studied about something about indirect transfer also. Later on, we studied about period of holding, how capital asset is categorized as long-term capital asset and when it is categorized as short-term capital asset. After completing the definition portion, we came to computation portion where we were taught how capital gain is computed. Simply considering sales consideration, reducing transfer expenses, arriving at net consideration and reducing cost of acquisition, cost of improvement, we arrive at capital gain. Depending upon period of holding, it is whether long-term capital gain or short-term capital gain, we tax it accordingly. After computing capital gain, we came through certain provisos to be considered while calculating capital gain. First of them was if any foreign person or if a non-resident or a foreign company invests in shares or securities in India, then any forex gain or loss on account of forex fluctuations is to be ignored. For that matter, what we used to do, we used to calculate everything in foreign currency. Second proviso was indexation. Whenever there was long-term capital gain, we were supposed to index the cost of acquisition. How indexation was done? Multiply cost of acquisition by the CII of the year of transfer and divide it by the CII of the year of acquisition. For an asset acquired before previous year 0102, we used to have fair market value as on 1st April 2001. For improvement done before 1st April 2001, it was completely ignored. And for immovable property, if we were having SDV along with fair market value, then fair market value can never be greater than SDV. This was all we had studied in second proviso. Third proviso was, sir, in 112A securities, in listed securities or in capital gain under section 112A, you never get the benefit of indexation. Fourth proviso was we do not get indexation benefit in debentures and bonds, but indexation is available in case of capital index bonds and sovereign gold bonds. Fifth proviso, same as first proviso, any foreign exchange fluctuations or gain or loss in case of RDB redemption for individual is to be ignored. Seventh proviso, FMV for the ESOPs shall be considered as cost of acquisition for the employees and balance is taxable in the salary head. Seventh proviso was any STT paid can never be considered to be reduced from full value of consideration, nor it is to be reduced in transfer expenses, nor it is to be added in the cost of acquisition. These were the 7 provisos we studied yesterday. Apart from 7 provisos, we studied how to compute full value of consideration. Right away, starting from section 50C, right away, starting from what full value of consideration means. Full value of consideration means any sum derived by selling such assets. In case of immovable property, full value of consideration is considered based on 50C. What 50C says, if any SDV is greater than 110% of consideration, then SDV shall be deemed to be consideration. What if you are not satisfied with the SDV? You can request assessing officer to refer your case to valuation officer and based on that valuation officer will determine SDV. If you are not satisfied with the valuation determined by the valuation officer, you can take the previously determined SDV, or in case you are satisfied with the valuation officer's SDV, you can take his SDV. If there is difference between SDV on the date of agreement and the SDV on the date of registration, which SDV you will be taking, you have to see whether on the date of the agreement did you pay any sum by account pay check, account pay demand draft or electronic clearing system. If any sum is paid by such medium, then SDV on the date of agreement will be taken, otherwise SDV on the registration date will be taken. This was all about 50C. 50D, what 50D we studied about unlisted shares. In case any unlisted shares are sold, How do we calculate full value of consideration? We have to take FMV or sales price, whichever is higher. But this provision was not applicable in case of companies, in case of private limited companies, whose board of director was suspended. Later on, we came to 50D, which said that if any company, if any asset whose fair market value cannot be determined, whose sales price cannot be determined, its sales consideration will be FMV on the date of the transfer. Later on, under section 55, we came across through cost of acquisition, where we understood any price paid to acquire the asset and to obtain the clear title on the asset will be considered as cost of acquisition. Second thing, we studied about a few important cases, special cases. What if asset is received on account of exempt transfer? What will be the capital? What will be capital gain in that case? What will be cost of acquisition? The cost of acquisition of the previous owner will be considered in that sense. If a intangible asset is acquired, then whatever purchase price we are paying, that will be full value of, that will be cost of acquisition. But if such intangible asset is still generated, then cost of acquisition will be nil in that case. But if any asset is available, we do have a benefit of FMV as on 1st April 2001. But for any intangible assets, FMV of 1st April 2001 is not applicable. If we have any depreciable asset, then value cost of acquisition will be considered after reducing depreciation. For bonus shares, if any bonus share is allotted before 1st April 2001, FMV as on 1st April 2001 is considered. But if bonus is allotted after 1st April 2001, FMV bonus cost of acquisition will be considered as nil. But if such bonus shares are listed on recognized stock exchange, then you can take the grandfathering value or FMV as on 31st January 2018. We will be studying about this later on. Right shares, whatever price paid to the company for acquisition of such right shares will be cost of acquisition. But in case such right shares are renounced, then whatever renouncement price you are receiving, that will be your short-term capital gain, and whatever price that renounced person has paid to you will be his cost of acquisition, along with the price that he paid to the company will be his cost of acquisition. For sweat equity shares, cost of acquisition will be FMV on the date of the exercise. And for depreciable asset, it will be WDV of the assets. For assets acquired before 1st April 2001, we have to consider FMV as on 1st April 2001 or purchase price, whichever is higher. And for shares issued in case of demerger, we used to say cost of acquisition in case of demerged company divided by net worth of the demerged company into book value of the asset transfer. We studied an example relating to this. That example made our concept very clear. Then we jumped to the part of special cases in capital gain. This is really very important topic because you can expect question from this topic only. So in special cases, we had two parts. First part was exception to section 45(1). 45(1) says capital gain shall be taxable. Sorry, profit shall be taxable under that capital gain in the year in which transfer took place. Any gain arising from the transfer of the capital asset shall be taxable under that capital gain in the year in which transfer took place. What if transfer takes place in a year but capital gain is taxable the other year? These four cases tell the exactly same situation. So yesterday we studied about the first situation, which was capital asset is destroyed and insurance is received. In that case, the year in which capital asset is destroyed will be year of transfer. But taxability will arise in the year in which you get insurance. So how capital gain will be calculated? You will be taking sales consideration as the amount of money received as insurance, or if you are receiving any asset, then FMV of that asset will be considered, and indexation and cost of improvement has to be reduced. For that matter, till how long you will be indexing? You have to index it from the year of acquisition till the year of transfer. That is the year in which asset got destroyed. Till then you have to index. You don't have to index till you receive the compensation. And period of holding shall be considered same for period of holding shall be considered from the date of acquisition till the date of transfer and not till the date of receiving the compensation. From today onwards, we have to start with the second case. What second case says? Conversion of capital asset into stock in trade. What if a capital asset is converted into stock in trade? We have studied that conversion of capital asset into stock in trade is termed as transfer. Definition of transfer clearly states conversion of capital asset is a transfer. So which means capital gain is leviable in case of such transfer. Yes, sir, capital gain is leviable. For example, I bought a land on 1st April 2016. For example, land was of 10 lakhs rupees. I was waiting for value to appreciate, but it never appreciated. What happened? On 1st April 2020? I thought to convert such land into stock in trade. I thought, why not to become property dealer? Why not to construct building on this land and sell property wise? I will be earning more than that. This is the date in which capital asset got converted into stock in trade. And this is the date on which capital gain is leviable in my hands. So capital gain has to be computed on this year, on this date. But there is an issue. There is an issue here. Is it okay to tax me such capital gain just with an intention to change the nature from capital asset to stock in trade? Do you see any money coming to me to pay tax? Do you see any money coming to me? I have just changed the nature of such asset. Earlier it was capital asset, I converted it to stock in trade. But do you see any money inflow? There is no money inflow in that transfer. So is it sensible enough to charge capital gain on such transfer? Right answer, it is not sensible. Therefore, government made a provision, or income tax lawmakers made a provision that your case will be considered as transfer here itself, but you will not be taxed here. You have to pay tax in the year in which such stock in trade is sold later on. For example, I converted my capital asset into stock in trade on 1st April 2020. So capital gain will be calculated here. Capital gain will be applicable here. But I have to pay tax in the year in which such stock in trade is sold. For example, on 1st April 2024. 1st April 2024, half of the land is sold. First half of the land is sold. So how my capital gain will be calculated? We have to determine the fair market value on the date of conversion. Let us suppose fair market value on the date of conversion is 50 lakh. Now you have to calculate capital gain here itself. How capital gain will be calculated? You have to take FMV. FMV will be sales consideration on the date of conversion. You have to do indexation, index cost of acquisition. That will be 10 lakh divided by year of acquisition. CII for the year of acquisition will be 1st April 2016. 1st April 2016. 1st April 2016, 16, 17, 264 and 21, 2301. Two 64 will be CII of year of acquisition, and 301 will be CII of the year of transfer. Again, here you have to index till the year of transfer. You don't have to do indexation till the year of sale of stock in trade. Indexation is to be done till the year of transfer. For that matter, our index cost of acquisition will be 11.4, and prospectively capital gain will be 38.6 lakhs. 38.6 lakhs will be capital gain. Now this capital gain will be calculated in the year itself, in previous year 2021 itself. But it will not be taxed in my hands. It will be taxed in the year in which such capital asset, such stock in trade is sold. So for example, my stock in trade is sold in previous year 23-24. That too, my half of stock in trade is sold. See, half of the land is sold here. Half of the land is sold. So capital gain will be leviable in my hands. That to half only capital gain will be applicable in my hands. So what will be half of this amount? Half of this amount will be 19.3 lakhs. So 19.3 lakhs will be capital gain. That 19.3 lakh capital gain will be taxed in my hands in previous year 23-24 when such stock in trade is sold. Did you get this point or not? Yes, sir, we did get your point. Sir, for example, this stock was sold for, let us suppose, 75 lakh. 75 lakh it was sold. 75 lakh. Half of the property was sold for 75 lakh. Can you calculate the amount of PGBP? Can you calculate the amount of PGBP? It is very clear. From the date of the conversion till the date of sale of stock in trade, this income will be taxable under the head PGBP. You all know very well. From the date of conversion till the date of actual sale of stock in trade, income will be taxable under the head PGBP. How PGBP will be calculated? So sales will be 75 lakh only. Cost of acquisition for half of the property will be FMV on the date of conversion. So FMV on the date of the conversion was 50 lakh. 50 lakh was for whole plot. But if I consider it half, so our cost of acquisition will be 25 lakh and income taxable under that PGBP will be 50 lakh. As simple as it can be. As simple as it can be. This is only written in English. If you see capital gain, full value of consideration will be FMV such asset on the date of conversion. Cost of acquisition, index cost of acquisition will be till the year of conversion. Sir, cost of improvement will also be indexed till the year of conversion, and long-term capital gain, short-term capital gain will be considered from the date of acquisition till the year of conversion. And PGBP will be taxable in my hand. You have to consider sale value of such stock in trade and cost of acquisition fair value on the date of acquisition. You have to proportionate the amount of cost of acquisition based on FMV on the date of the conversion. If proportionate stock is sold, then proportionate amount of capital gain is taxable. This is very simple. Amount recorded in books of accounts is not relevant. What if property was bought at 10 lakh rupees and it was converted, and in books of accounts our FMV was recorded as 20 lakh rupees? Is it anywhere relevant? No, it is not relevant in any sense. You have to look out for actual FMV, fair market value of such property, and based on such FMV you will be taxed the capital gain accordingly. Now if you remember, there was a section 54 EC, where if any individual had any kind of capital gain arising from immovable property, he can exempt his taxes up to 50 lakh rupees by investing in bonds of NHAI RECL. But such bonds were to be acquired within 6 months from the date of the transfer. We did study that, if you remember. Which means under section 54 EC, if you want exemption under section 54 EC, you can get exemption up to 50 lakh rupees. But for such exemption, you have to buy bonds, and that bonds are supposed to be bought within 6 months from the date of the transfer. Here in this case, transfer took place in previous year 2021. How can we buy bonds within 6 months from the date of the transfer when we had no money? When we had no money, how can we buy bonds here? So right answer is, provision says need not to buy from this date. You can buy as soon as stock in trade gets sold. Ultimately, 6 months time limit here will not be taken from the date of the transfer, but it will be taken from the date of sale of stock in trade. Did you get this point or not? This simply means that capital gain will be taxable, or exemption period, 6 months period for claiming the exemption under section 54 EC will be applicable from the date of sale of such stock in trade and not from the date of the transfer. That is the bottom line. It is even logical. If I have not written this point, you might have considered this date only. So this was special case number 2, where capital asset is converted into stock in trade. Next provision is, I had a property and I used to flaunt about it too much. God heard me. He said, how can he let me flaunt this much? There was a notice received in my hand. Rahul, your property will be acquired by the government because there is a railway project to be undertaken in your property. There has to be a railway line passing through your property. Your property will be compulsorily acquired. And for that matter, I was awarded compensation. Can I say compulsory acquisition is also a kind of transfer? Yes, sir, compulsory acquisition is also a transfer. But is it wise to tax me in the year in which compulsory acquisition took place? No, sir. Therefore, it is an exception where transfer is taken place in the year in which asset is compulsorily acquired, but it shall be taxed in the year in which compensation is received. It shall be taxed in the year in which compensation is received. So for that matter, we decide 2 types of compensation. For example, my house was compulsorily acquired and I was awarded compensation of 20 lakh rupees. I was not satisfied this compensation. I went to court. That court, listen, I want more compensation. Later on, court awarded me compensation of 60 lakh more. Earlier, I was awarded 20 lakh. Now I am awarded 60 lakh more by the court. This initial compensation is nothing but it is called initial compensation, and this later on enhanced compensation is nothing but it is called enhanced compensation. Okay, did you get this point? Initial compensation shall be taxable in the year in which first installment is received. For example, I was awarded 20 lakh compensation, out of which first 5 lakh is received in first year itself. So initial compensation, this whole 20 lakh will be taxable in the year in which 5 lakhs are received. What will be full value of consideration? Let us consider this with an example. My house was bought in previous year 2016-17 for 10 lakh rupees. Compulsorily acquired in previous year 2021. Compensation decided 20 lakh. Later on, I received compensation in previous year 23-24, 20 lakh, and previous year 24-25. I received additional compensation of 60 lakh. How capital gain will be calculated? See, transfer took place in previous year 2021, but I will be taxed such capital gain in previous year 23-24 because compensation is received therein. So for that matter, previous year 23-24, sales consideration will be amount of initial compensation, that is 20 lakh, less cost of acquisition, index cost of acquisition. So 10 lakh divided by 264 into 301. 11.4 lakh will be cost of acquisition, and capital gain will be 8.6 lakhs rupees. Capital gain will be 8.6 lakhs rupees. Later on, when I received this enhanced compensation, how capital gain will be calculated? Sir, in previous year 24-25, whatever the amount of enhanced compensation will be considered as sales consideration, that will be taxable as whole 60 lakhs. Sir, any cost of acquisition? Already you have taken complete cost of acquisition here. Why will you take cost of acquisition again? You have already taken cost of acquisition there. Why will you take again? Here, no cost of acquisition will be reduced. Only a kind of litigation expense that you have paid, like lawyer's fees or any fees that you have paid on this litigation, will be reduced. Any litigation fees, for example, 1 lakh is being paid to lawyer to get this case done. So that litigation fees will be reduced and capital gain will be computed accordingly. Did you get this point on? Okay, sir, we did get. Can I say capital gain computed in previous year 23-24 based on initial compensation was long-term capital gain because my property was acquired in previous year 16-17 and was compulsorily acquired in previous year 20-21. So period of holding is more than 3 years, more than 2 years. This capital gain is long-term capital gain. I just want to tell you, in case capital gain is long-term capital gain when calculated on the basis of initial compensation, any capital gain calculated on the basis of advanced compensation, enhanced compensation will have same nature as initial compensation. What I am trying to say is, if capital gain on initial compensation is long-term capital gain, on enhanced compensation also it will be long-term capital gain. If capital gain on initial compensation is short-term capital gain on enhanced compensation will also be short-term capital gain, long-term capital gain. It has to be same for both the cases. That means any capital gain calculated either long-term or short-term will give this capital gain the same nature. This is what the bottom line is. Did you get this point or not? This is the taxability of initial compensation and enhanced compensation. Again, indexation is to be done till the year of compulsory acquisition. Period of holding is to be checked till the year of compulsory acquisition from the date of acquisition. From the date of acquisition till the compulsory acquisition date. This is the period of holding to be checked. Now, what if sometimes happens is now this 60 lakhs is not fixed. My property was acquired. I was awarded initial compensation of rupees 60 lakh. I went to court. Initially 60 lakhs were not awarded. Court said to government, pay him 10 lakh rupees and later on we will decide what will be compensation, what will be enhanced compensation. Which means sometimes court gives an interim order to pay certain compensation to me. Court gives an interim order to pay some enhanced compensation to me. When will such enhanced compensation be taxable? The right answer is when court will pass the final order. Any enhanced compensation received on account of interim order of the court will be taxable in the year in which final compensation is received. Did you get this point or not? You have to read this line twice, then you will understand better. If any enhanced compensation is received on account of interim order of the court, then it will be taxable in the year of final receipts. Did you get this point or not? Yes, sir, we did understand what you are trying to say. We did understand. See, what happens is there is an issue. There has been an issue. Just think of a case My property was acquired in previous year. My property was bought in 1617. Compulsory acquired in previous year 2021. But I am awarded compensation 4 years later. 4 years later, I am awarded compensation 4 years later. Don't you think I should be given interest on that? Yes, sir, interest is awarded. But is it on my? Is that delay on my account? No, it is not my. No, delay is not on my account. So for that matter, any interest received on account of compensation paid on account of compulsory acquisition of land will be deductible by 50%. That means any interest received on account of compensation on compulsory acquisition land will have 50% standard deduction, or 50% deduction will be allowed on such interest under section 57. Did you get this point or not? Okay, sir, we did get this point. Sir, what if in case of death of the transferor? For example, my property was acquired and my property was bought in 1617. It was acquired in previous year 2021, but I died in the previous year 21-22. Just look at this case. My property was acquired in previous year 2021. I died the next year, and compensation was received in previous year 23-24. In whose hands it will be taxable? Right answer is in the hands of the legal hire. It will be taxable. Okay, sir, we did get your point. Last but not the least, last second point, any compensation received on account of section 96 of right to fair compensation, land acquisition, rehabilitation, resettlement act shall be exempt. I have written the short form. You need not to remember long form. If you see any act referring these 8 words, just write it as exempt. You need not to learn anything. So any compensation received on account of right to fair compensation under section 96 of right to fair compensation, land acquisition, transparency, rehabilitation and resettlement act will be exempt. Okay, sir, we did get your point. Now there was a case law. I want you to go with the flow. I had a land bought in previous year 1617, 10 lakh. Compulsorily acquired previous year 2021. As soon as property was compulsorily acquired, I did not go anywhere else. I simply went to collector and I wanted to increase the initial compensation. I did not go to court. I did not go anywhere. I just went to collector to get my compensation enhanced. Does that mean I'm willing to sell my property? I'm just agreeing with the fact that my property has been compulsory acquired. Does that mean I'm willing to sell? These two are different terms. I'm agreeing with the fact that my property is compulsorily acquired is completely different from my willingness to sell. Just because my property is compulsorily acquired and I went to collector to get my compensation enhanced does not mean that this compulsory acquisition will be termed as willful sale, which means government cannot ask you to pay tax in the year of compulsory acquisition just because you went to collector for enhanced compensation. That means government cannot recharacterize the nature of compulsory acquisition to willful sale if you went to collector. This was a case law. I just wanted to give you reference of it. It is not that relevant, but yes, it is the thing that you must remember. Capital gain in case of joint development agreement. I am giving this thing on hold. I am leaving this thing on hold. I remember whatever things I am leaving on hold. This thing will come again. This thing will come again. Capital gain in case of joint development agreement. Let us understand this with an example. This is Mr. Rahul. Mr. Rahul has a property of 1 acre. If you understand 1 acre or 1 hectare, I should say 1 hectare, bought at previous year 1617, for 1 CR. Now, what will I do of this property? I gave this property to a real estate developer. Real estate developer. Say Lodha developer. If you remember, if you know Lodha developer. What I wanted from Lodha developer is just take this land, construct a property on it, and in return give me some money and some flats in this property. I just want this thing. Now, what Lodha developer will do? Say for example, I transferred this property in previous year 2021. I just want Lodha developer to develop property on this land and in return give me just money and flat. So in previous year 23-24 completion certificate got they received completion certificate. Lodha developers received a completion certificate and they handed me possession of 5 flats of 50 lakh each and 2 CR in cash. That means nearly 4.5 CR is the compensation I received. Now just imagine the case, What is happening here? I am transferring my property to Mr. Lodha in previous year 2021 under joint development agreement. This structure is joint development agreement. This structure is joint development agreement. I am transferring my property from previous year 16-17 in previous year. I am transferring property bought in previous year 16-17 in previous year 2021. Can I say my property, the transfer took place in previous year 2021? Can I say transfer took place in previous year 2021? Yes, the transfer did take place in previous year 2021. Is it wise enough to tax me in that year? Because I have not received any money. How will I pay taxes? How will I pay taxes? Right answer is you will not be able to pay taxes. For that matter, lawmakers have made a provision that pay taxes only when you receive money or consideration in return. So you will not be taxed in the year in which you transferred property to real estate developer, but you will be taxed in the year in which you receive flats. No, in which completion certificate is received. In the year in which completion certificate is received. Did you get this point or not? How capital gain will be calculated? Just have a look. Sales consideration will be nearly 5 flats, 50 lakhs into 5 plus 2 CR will be 4.5 CR. Cost of acquisition will be 1 CR divided by year of acquisition 264 CII of the year of acquisition multiplied by CII of the year of transfer will be it will be 301. It will be 1.14, 3.36. This will be amount of capital gain applicable to me, but this will be taxed in the year in which completion certificate is received and not the year in which transfer took place. Therefore, this is also an exception to the charging section 45. Did you get this point or not? Yes, sir, we did understand. We did understand what you are trying to say. It is easy. Okay. Now answer these questions. I received these 2 flats now in previous year 23 and 24. I sold 1 flat for 75 lakh. I sold 1 flat for 1 CR. Okay, 1 CR. Now just to tell what will be the capital gain applicable in my hands. So sales consideration is very clear 1 CR. Sales consideration is very clear 1 CR. Now we have to reduce cost of acquisition from it. Reduce cost of acquisition. Since period of holding is lesser than a year, so it will be short-term capital gain. We don't have to index here. What will be cost of acquisition? Sir, cost of acquisition will be, it can be either 50 lakhs. 50 lakhs, what will be 50 lakhs SDV of each flat received, or it can be 4.5 lakh divided by 5 because I received 4.5 lakh for 5 flats. I received total rupees of 4.5 lakh or for 5 flats. Can I say I received 4.5 CR for 5 flats. So ultimately SDV value turns out to be 90 lakhs. Can I say? You're understanding me what my issue is. What will be cost of acquisition for each flat? Will it be SDV on the date of the SDV on the date of receipt of such flat, or will it be total consideration received divided by number of flats? Right answer is SDV will be cost of acquisition will be SDV. Cost of acquisition will be SDV of year of cost of acquisition will be SDV of the flats in the year in which we received such flats, which implies complete cost of acquisition will be 50 lakhs. Complete cost of acquisition will be 50 lakhs. So cost of acquisition will be 50 lakh and capital gain arise will be short-term capital gain and it will be of 50 lakhs rupees only. Did you get this point or not? Did you get this point or not? Did you or did you not get this point? Yes, sir, we did understand. We did understand. This was all about this was all about joint development agreement. Two things to be taken care. This provision is applicable only for individual and HUF. No SC, no SSC other than individual and HUF can enter into a joint development agreement. They can enter actually, but they will not be given benefit of this section. That means they will be charged to tax in the year in which they transfer their property to real estate developer. Second thing, what if in this case, I transferred my property previous year 2021 and I received property. I received flats and cash in previous year 23-24. What if I was in a need of money? I sold such flats before receiving such flats. Is it possible to sell? Yes, sir, it is possible. It is possible to do agreement for sale. That as soon as I will be receiving flats, I will be giving possession to you. Can I do agreement for sale before receiving such flats? Right answer is yes, I can sell such flats before receiving such flats. In that case, I will not be entitled for this benefit. I will not be entitled for this benefit. That means tax will be charged in the year of transfer only if I sell such property before receiving completion certificate. This is really, really very important point that in case of joint development agreement, if a person transferring property to the real estate developer sells such property before receiving completion certificate, then he shall be chargeable to tax in the year in which transfer took place and not in the year in which he received such consideration. Did you get this point or not? So we did get you. We did get you in depth. You are speaking in this power batch. We are not able to understand how depth you are teaching. Let me reach to assessment procedure or NR taxation. Then you will find out the real me. You will get the real benefit of this DT. You will understand the depth of DT when you will study assessment procedure or non-resident taxation from me. These were all about basic special cases. As I said, special cases are of two types, part 1 and part 2. Part 1 was exception to section 45, that is exception to charging section, where capital gain will be taxable not in the year of transfer but in some other year. This was special cases part 1. Now let us go to special cases part 2. Special cases part 2. Special cases part 2 right away start from ULIP taxation. ULIP taxation. First of all, I am drawing a chart with I am drawing a chart. Just follow me. Just follow me. If there is any life insurance policy, what is ULIP? I know everybody. I think everybody of you know what is ULIP. So I'm not getting into the details of ULIP. I'm just telling you what 1010D says. 1010D. If any life insurance policy or ULIP has premium greater than 10% of sum assured, then maturity of such life insurance policy is taxable. It is very clear. In case of any ULIP or life insurance policy, if premium is greater than 10% of the sum assured, maturity of life insurance policy is taxable. Sir, in which head it will be taxable? It will be taxable under the head IFOS. It is liable for TDS under section 194D. Sir, what if premium is lesser than or equal to 10% of sum assured? Then what happens? Sir, earlier it was exempt. Earlier it was exempt. But for ULIP, there was amendment. What amendment? Sir, before 1st Feb 2021, any ULIP of any value was exempt. The only condition was sum assured has to be, premium paid has to be lesser than 10%, or premium paid has to be less than equal to 10% of the sum assured. This was the only condition before 1st Feb 2021. But after 1st Feb 2021, Finance Minister added another condition. What condition? From 1st Feb 2021, aggregate if aggregate premium less than 2.5 lakh per annum, yet again exempt. But if greater than 2.5 lakh per annum, then it will be considered as taxable. Then it will be considered as capital asset, as we said in the definition of the capital asset, and then it will be taxable under the head capital gain. Did you get this point or not? People were exploiting the use of ULIP. People were exploiting ULIP. Therefore, government has to take action that even if premium paid is lesser than 10% of sum assured, yet maturity will be taxable in case aggregate premium exceeds 2.5 lakh after 1st Feb 2021. Not only this, people were so intelligent. Government has to introduce another thing. Sir, for life insurance policy. Sir, if issued before 1st April 2023, exempt any life insurance policy whose premium was lesser than or equal to 10% of sum assured, it was completely exempt. But from, wait a second, I need to reduce the size of it, otherwise I'll not be able to complete this in a single page. Exempt. Any life insurance policy issued before 1st April 2023 was exempt if premium was lesser than 10% of sum assured. But from 1st April 2023, this is really very important amendment for your examination. If premium up to 5 lakh, then exempt. Premium beyond 5 lakh, then it will be taxable. And one thing to be taken care of is, while calculating premium, GST portion is to be ignored. For example, just giving an example, for example, premium is 4.8 lakhs. GST on it will be 0.0864. Total premium will turn around to be 5.664. What is the aggregate premium for the financial year? It is 5.664. Can I say the maturity will be taxable? Right answer is maturity will not be taxable. If premium before GST amount is lesser than 5 lakh, then maturity will not be taxable with effect from 1st April 2023. This is a really very important amendment. I have seen many books, multiple books, but nobody has simplified to this extent. Nobody has simplified to this extent. I have tried to do these things for you. Hope you can appreciate this. Okay, now let us switch to ULIP. There is a very classic example given in your book. There is very classic example given in your book. I just want all of you to have a look at this example. A ULIP was issued on 1st April, 1st Feb 2021. ULIP was issued 1st Feb 2021. Sir, if premium is lesser than 10%, it has to be exempt anyhow. Any amount will be exempt. Premium is 5 lakh, sum assured is 50 lakh. Yes, sir, sum assured is premium is 10% of sum assured. That means maturity will be exempt. I don't have to look at maturity even. I don't even have to look at maturity. It will be completely exempt under 1020. Okay, now new ULIP has been bought on 1st Feb 2021. Now I have to look for 10%. Along with that, I have to look for aggregate premium up to 2.5 lakh rupees. Sir, maturity after 8 years, annual premium 1.2 lakh, sum assured 12 lakh. Sir, can I say that annual premium is lesser than 10%, lesser than equal to 10%? Yes, sir, annual premium is equal to 10%. Sum received. Sir, can I say amount is lesser than 2.5 lakhs, so it will be exempt? Yes, sir, it will be exempt, no issue. On 1st March 2022-21, in the same financial year, I did buy another ULIP. ULIP of rupees sum assured 13 lakh and premium is 1.3 lakh. Can I say again premium is 10% of sum assured? Yes, again maturity will be taxable. And if I'm considering in aggregate, then too we are having aggregate of up to 2.5 lakh. So again it will be exempt. Can I say ULIP 2 and ULIP 3 in aggregate of annual premium, it is 2.5 lakh. It is within the threshold limit, so it will not be taxable on maturity. Yes, sir, it will not be taxable. But on the very next month, I don't know how much, I don't know I don't know from where I get money. I bought another ULIP of rupees 24 lakh rupees sum assured. And annual premium is 2.4 lakh rupees. Again, I can say that premium is equal to 10% of sum assured. So I just have to look, I just have to look aggregate premium up to 2.5 lakh. Can I say, since it is new financial year, aggregate premium is up to 2.5 lakh? Aggregate premium is up to 2.5 lakh. Yes, sir, it is correct that aggregate premium is 2.5 lakh rupees. Can I say, will it be exempt? You have to wait for that. You have to wait for that. What I am saying, just listen. In this financial year, previous year 21-22, in February, I am paying this installment of 2.4 lakh. But when February will come, I have to pay this installment. I have to pay installment of this ULIP also. I have to pay installment of this ULIP also. That means, can I say that in aggregate, I am paying premium for 1.2 lakh, 1.3 lakh, and 2.4 lakh? Can I say that for a single financial year, I am paying 3 installments aggregating to 4.9 lakh rupees? Now you have to decide which ULIP will be exempt and which ULIP will be taxable. Now you have to decide which ULIP will be taxable and which ULIP will be exempt. For that matter, government is giving you choice. Either you can go with ULIP 1 and ULIP 2 collectively to be exempt and ULIP 4 to be taxable, or vice versa. You can go with ULIP 4 to be exempt and ULIP 2 and 3 to be taxable collectively. In that sense, your capital gain will turn out to be 3.4 lakh, 3.6 lakh, and 5.8 lakh in aggregate if you consider. So option 1 is better. Getting a ULIP number 2 and 3 exempt is a better choice than 4. So therefore, it is advisable to go for option number 1, where either 2 or 3 is exempt and ULIP number 4 is taxable. This is how you have to work out. ULIP number 5, 3.5 lakhs, 35 lakhs. Since premium is equal to 10% of the sum assured, we have to check aggregate premium. Since single premium in itself is greater than 2.5 lakh, we don't have to check it directly. It is taxable. Directly, the maturity is taxable. The life insurance policy. For life insurance policy, just have a look. So sum assured is 1 lakh. Sum assured is 1 CR. Premium paid is 6 lakhs rupees. Can I say, just be with me. Can I say that premium is lesser than 10% of sum assured. Yes, sir, premium is lesser than 10% of sum assured. 10% of sum assured will be 10 lakh, premium is lesser than 10 lakh. That means I am falling within that 10% limit. I have to check whether premium is greater than 5 lakh. Yes, sir, premium is greater than 5 lakh. So in that case, maturity will be taxable. How maturity will be taxable? I need all of you to have a look here. This maturity will be taxable under that IFOS, that has to be known. That has to be very well known. Sir, how taxability will arise? Just understand this fact. Sir, some assured or maturity will be 1 CR. For 10 years, I am paying premium of rupees 6 lakhs rupees, 6 lakhs into 10. 60 lakhs I am paying. Do I have to, can I say that cost of acquisition for this policy will be 60 lakh rupees? Is it correct to say? Is it correct to say cost of acquisition of this policy will be 60 lakh rupees? Right answer is no, it is not correct to say. Why, sir? Why it is not correct to say? Because you have taken benefit of 80C against this policy. Can I say? Can I say? Can I say? Every year when you used to pay the life insurance policy, you used to take 80C deduction of 1.5 lakh rupees. You used to take 80C policy because you get benefit of 80C whenever you are investing in life insurance policy. So whatever premium, whatever deduction you have taken for 80C, under 80C, for this life insurance policy is to be reduced from cost of acquisition. That means I have paid 6 lakh. Out of that 6 lakh, 1.5 lakh is already taken as deduction in under section 80C. So cost of acquisition will be 45 lakh rupees only, and taxability under IFOS will be 655 lakh. Did you get this point or not? Are Baba, tell me, did you get this point or not? Yes, sir, we did get your point. Now, I just want all of you to just have a look at what content says, because concept is over. You just have to look at content. Any amount received under Keyman insurance policy is taxable under the head PGBP. If annual premium is more than 10%, 15%, 20% prescribed limit under section 80C, then it is taxable. Exempt if it is received on death. If it is received on death, it is exempt. Any life insurance policy that is even taxable now at maturity will be exempt if it is received on death. Received against ULIP, any amount will be taxable if it is received against ULIP on or issued on or after 1st Feb 2021, and premium payable in aggregate exceeds 2.5 lakh in any previous year, taxable under that capital gain. If more than one ULIP, then exemption will be available only for those ULIP whose aggregate premium does not exceed 2.5 lakh. Like in our case, what happened was aggregate of two ULIP, 1.2 lakh and 1.3 lakh was up to 2.5 lakh. So I can take exemption against those ULIPs. And balance units were simply taxable under that capital gain. If a policy other than ULIP is issued on or after 1st April 2023 and aggregate premium payable exceeds 5 lakh in any previous year, then it will be taxable under that IFOS, and it will be exempt received on death, and I have to exclude GST component of GST component. If policy is taxable because it exceeds 10%, it will be taxable under that. You don't have to remember anything. You just have to remember this chart. I'm giving you time. I'm giving you time for 10 seconds. Just take a screenshot of this chart because it is not given in your book. You can take screenshot, or I'll be sharing board notes. You can take benefit from that also. Okay. Shall we proceed? Yes, sir. What are you waiting for? Arey Baba, I was waiting for you. And one thing to be remembered, ULIP, on ULIP, you will not get any indexation benefit, and it will be taxable under section 112A, because ultimately you are investing in equity oriented mutual funds. So in case of long term game, it will be taxable under section 112A, and there will be no indexation. Already you don't have any indexation for assets taxable under section 112A. You will not get any indexation, and it will be taxable under section 112A. That means 10% exceeding the amount of 1 lakh rupees. Did you get this point or not? Yes, sir, we did get this point. Slum sale. I want all of you just to not look at this book, just to not look at this book, just to look at this board notes while I'm writing. Slum sale simply means transferring an undertaking without assigning single value to the assets. Without assigning value to any individual asset, just selling complete unit for a single consideration. I have different types of assets, different types of liabilities. I'm not valuing anything. I'm just valuing the whole undertaking and receiving something in return. How slum sale will be calculated? As good as, sir, sales minus cost, sales consideration minus cost of acquisition. These two things I have to consider. Sales consideration minus cost of acquisition. I have to consider these two things and I will be getting the capital gain in the slum sale. Basic is I am transferring my whole unit for a single price without assigning value to say individual assets or liabilities. I'm not assigning assets or liabilities individually. I'm just assigning value to whole unit. That is where the role of slum sale comes into picture. Did you get this point? Sir, we did get your point. Sir, how sales consideration is calculated? We have two methods, sir, FMV1 and FMV2. And cost of acquisition is calculated based on net worth. Now, complete picture lies in calculating these three things. Complete picture lies in calculating these three things. We need to understand how to calculate FMV1, we need to understand how to calculate FMV2, and we need to calculate how net worth is calculated. I'm telling you bottom line, FMV1 means assets given means assets received. So how FMV1 is calculated? Just be with me, just be with me. If you have any jewelry, painting, take open market value of that painting. If you have any painting in your undertaking that is being transferred, just take open market value of that painting. If you have any jewelry in your undertaking, take open market value of that. If you have any shares, how open market value will be calculated? It will be based on chartered accountant's report or merchant banker's report. If you have any share securities, just take fair market value. How this fair market value will be calculated? So fair market value is simply calculated by valuation rules under section 11 UA, or for listed securities it will be average price of the average last trading price. If you have any immovable property, then just take SDV of that. And any other asset, take book value, ignoring revaluation. I just need to check whether revaluation is to be ignored or not. No, here you don't have to ignore revaluation. Less liabilities transferred. So all the assets that I am transferring, I am considering fair market value of all these assets. Any assets that cannot have any fair market value, I am using book value of such assets. Reducing the liabilities. And it is very obvious, contingent liabilities are not liabilities, general reserves are not liabilities, sir, provisions are not liabilities, reserves are not liabilities. Provision for tax is not liability. These are not liabilities. Unascertained liabilities, not liabilities. These are not liabilities. You don't have to reduce these things from liability portion. But you have to adjust TDS, TCS, and advance tax. I'll tell you how this is to be done. I'll tell you how it is to be done. Did you understand how to calculate FMV1? If you have any jewelry, take fair market value. If you have any shares, take if you have any jewelry, take open market value. If you have any shares, take fair market value. If you have any immovable property, take SDV. SDV or consider. Just give me a second. Yes, SDV. You have to take SDV. Any other assets take at book value and reduce liabilities, and these are not liabilities. For example, if you see TDS credit asset, for example, 20 lakh. If you see advance tax paid 10 lakh. If you see provision for tax, 40 lakh. And written here, excess by 15 lakh. What do you understand by these four things? First of all, you have to ignore all four things while calculating slump sale. First of all, you have to ignore all four things. Collectively, you have to ignore. You have to just look at one thing. What is the actual tax liability or what is actual refund receivable? You have to find out actual tax liability or actual refund receivable. How you are going to calculate it? Just have a look. Just think the way I am thinking. Can I say provision for tax is 40 lakh? That means whatever provision, whatever our thought process was, we were required to pay tax of 40 lakh rupees. But actual tax liability was 25, that 15. That means this provision is more by 15 lakh. That means, can I say actual tax liability was just 25 lakh? Can I say actual tax liability was just 25 lakh? The right answer is yes, actual tax liability was just 25 lakh. But I had already TDS and TCS credit available with me. Can I say this actual tax liability will be set off by already prepaid TDS and advance tax? So my refund receivable is just 5 lakh. So while calculating the total assets, I will be considering this refund. I will not be considering any such credit. I will not be considering any advance tax. I will not be considering any provision. I will not be considering anything. Just this refund amount will be reflected in my assets total, because this is my actual refund liability based on my actual tax liability. Did you get this point or not? With these things, now you will arrive at fair market value 1. Second thing that you need to do is fair market value 2. As I said, fair market 1 represents asset given. Whatever jewelry was taken away with the undertaking, I have to calculate value of it. Whatever shares that did go with the undertaking, we have to calculate that. Whatever immovable property that did go with the did go with the undertaking, we have to calculate that. But fair market value 2 says something different. It has to say what consideration you received. Either you can receive 5 lakh rupees cash bank. You can receive cash bank. You have to take cash bank. That is consideration you are receiving. Instead of cash bank, you can receive shares. So for that matter, you have to take FMV of the shares. Instead of shares, instead of money, you can receive jewelry. You can receive jewelry. Yes, sir, you can receive jewelry. For that matter, your consideration will be open market value of that jewelry. Instead of jewelry, can you receive any immovable property? Yes, sir, I can receive immovable property, and STV of that immovable property will be consideration. So instead of getting just money, if you are getting any other asset that is listed here, you have to consider fair value of those assets as FMV2. And higher of these two will be considered my actual sales consideration, and based on that, capital gain will be calculated. Did you get this point? Yes, sir, we did get. Cost of acquisition, net worth. How net worth is calculated? This, a thing cannot be simpler than this. A thing cannot be simpler than this. Just have a look. Depreciable assets. Take WDV. Ignoring revaluation. Non-depreciable asset. Book value. Just add book value. Whatever book value they state, you have to take. Liabilities. Book value. And again, contingent liabilities, unascertained liabilities, reserves are not liabilities. Provision for tax. These are not liabilities. After calculating these things, you will arrive at net worth. Once you are done with fair market value, once you are done with FMV1, once you are done with FMV2, and once you are done with cost of acquisition or net worth, you will arrive at capital gain calculated on slump sale. So will it be long-term capital gain? Will it be short-term capital gain? You have to see period of holding for that undertaking. If that undertaking is held for more than 3 years, then it will be long-term capital gain, or otherwise it will be short-term capital gain. Sir, once slump sale occurs, this valuation of shares is to be done on valuation date. All these valuations are to be done on valuation date. And what is valuation date? It's a date of transfer. The date in which it is agreed that assets will be your ownership, then that date will be considered as valuation date. Did you get this point or not? And a chartered accountant's report is required to certify whether net worth has been correctly arrived or not, whether calculation of fair market value has been correctly done or not. This is to be certified by a chartered accountant before filing your tax audit report. This is to be certified, otherwise your slump sale will not be correct in terms of compliance. Just have a look at the portion. Slump sale means transfer of entire undertaking or a division for a lump sum consideration without assigning single value to individual assets. Computation of capital gain. Full value of consideration, sales consideration, FMV, less transfer expenses, less net consideration will give cost of acquisition. Do we have to do indexation here? Right answer is we are not assigning any value to assets, so indexation is not relevant. Indexation we don't have to do, we are not allowed to do. This will be net worth depending upon period of holding. It will be either long term or it will be short term capital gain. How net worth is calculated for depreciable assets? Take WTV as per Income Tax Act. For other assets, take book value, and for liabilities, include share capital, exclude share capital and reserves, and take all the liabilities at book value. You will arrive to net worth. If net worth is negative, take zero. Cost of acquisition will be zero. Cost of acquisition can never be negative. Correct? Ignore for any revaluation, or if any revaluation already done, then adjust for it. Sales consideration will be higher of FMV1, FMV2. How FMV1 is calculated? Take open market value of jewelry, take fair market value of shares, take stamp duty value of immovable property, take book value of all the assets other than these three, and reduce liability from these. What are the liabilities that need not to be reduced? So share capital is not liability, reserves and surplus is not liability, dividend is not liability, provision for tax is not liability, uncertain liability, contingent liability, these are not liability. And you have to ignore advanced tax, TDS, and deferred tax revenue. Deferred revenue expenses, like I told, you have to adjust for actual tax liability or actual refund receivable. FMB2 will be amount of consideration received, for example, money received, shares received, immovable property received, or any jewelry received. Then we have to consider these four things for finding out the FMV2. What is the valuation date? Date of the slump sale. SSC shall furnish a CA report before the due date of audit under section 44AB, indicating the computation of net worth and certifying that net worth has been arrived correctly. Tax savvy tools hold for some time. Once we are done with exempt transfer, we will be able to do this topic also. Next topic. Next topic. I want your attention for a few minutes because this topic is really very important, and at least I require your attention for 1 hour. At least I want your attention for 1 hour. Just listen to what I'm saying. 45.3, 45.4, and 9b. These three sections we need to study. There is nothing complicated in this. There is nothing complicated in this. I'm sure after studying from me, you will find out this topic at your tips. But I want your focus for next half an hour. At least half an hour, I want your focus. If partner transfers any asset to firm, capital gain in hands of partner. If I am a partner in a partnership firm, I transfer any of the asset to partnership firm. It is bound to happen that capital gain will be applicable in my hands. It is bound to happen. For that matter, how capital gain will be calculated? So sales consideration will be amount recorded in books of accounts. Amount recorded in books of accounts. Cost of acquisition will be my actual cost of acquisition. I will be reducing any transfer expenses, any improvement, any such thing done will be reduced, and I will arrive at capital gain. This section is called section 45(3). Done. How simple, how a thing can be simpler than this? We are done with one of the section. We are done with one of the section. Now let us assume partnership firm gives an asset to partner at the time of dissolution, at the time of reconstitution. We need to understand these three cases. First of all, let us go through an example. I have myself crafted this. Let's go through an example. This is the balance sheet of ABR. ABR 222 CR. Land 2 lakhs, previous year 17-18, bought in previous year 17-18, 2 CR. FMV, mm, 4 CR. Shares 2.5 CR. Other assets 1.5 CR. Can you check out for me whether balance sheet is tallying or not? Well, balance sheet is tallying, yaar. What you are saying? Okay. On 1st April 2023, R retired. R yani Rahul. R means Rahul retired. Rahul retired. To settle his dues, ABR gave him land. See how simple the transaction can be. Capital of Rahul is 2 CR. He is given land of 2 CR. How simple things can go. How government wants you to think. Just let's focus on that portion. Government wants to ask, if this land were not given to Rahul and if it were sold to outsider, what capital gain would have accrued to firm? Just tell me. Government wants to know, if this land were not given to Rahul and sold to outsider, what capital gain would have accrued to firm? Just calculate na capital gain. I'm just asking you to calculate. The one thing more, if Rahul is retiring, firm is revaluing assets. So firm is revaluing at 3.5 CR and other assets are revalued at, for example, 2.5 CR. Just I'm giving this number, abstract number. I'll refer this later, but just take this in mind. Things are revalued when partner retires. Capital gain. I'm just assuming that this land is sold to an outsider, not given to Rahul. If this land were sold to an outsider, what would capital gain have arisen in the hands of ABR? What capital gain would have arisen in hands of ABR? I'm not giving it to Rahul. If I would have sold this to an outsider, what capital gain would have arisen? Capital gain would be sales consideration. If this land were sold to outsider, 4 crore could have been easily, 4 CR could have been easily realized. Yes, it could have been easily realized. Cost of acquisition, or I should say index cost of acquisition, 2 CR divided by CII of the year of transfer, 272, 272 into 348. Can I say 2.56? 2.55 it is. I am just saying 2.56. What capital gain could have arisen in the hands of firm? 1.44 CR was the capital gain that was taxable in the hands of firm. What capital gain would have, what tax would have arisen, what tax would have accrued on this? Simply tax of 20% plus 4%. Tax of 20% plus 4%. Assume, ignore surcharge for now. Ignore surcharge as of now. Just calculate the tax liability. What will be the tax liability? 20% plus 4%. Can I say my tax liability would have been 10 lakh, 30 lakh rupees? Everybody with me? Everybody with me? Understanding what I am saying. What government is asking me to do is just calculate capital gain if this land were sold to an outsider. If this firm was selling this land to an outsider, then firm could have easily realized 4 crore rupees. Capital gain would have arisen in the hands of firm of rupees 1.44 CR, and tax was leviable in the hands of firm at rupees 30 lakh rupees. Now firm just wants one calculation. Firm wants one calculation. If this land were sold to an outsider, just calculate what partner's capital would have been. Just calculate partner's capital would have been. Just imagine partner's capital. Partner's capital. Sir, A, B are 2 CR. Already partner's capital was already 2 CR. Plus profit on sale. Profit on sale of land. Who can calculate the profit on sale of land? How much book profit would have been accrued to all the partners? Can anybody tell me? How much book profit would have accrued to all partners? Can I say, we were having land at rupees 2 CR, and now we could easily realize 4 CR. Can I say 2 crore of book profit can be easily booked if this land were sold to an outsider? This taxable capital gain is irrelevant because of this indexation concept. This is only for income tax purpose. But for accounting purpose, can I say book profit would have been 2 CR? Can I say book profit would have been 2 CR? Yes, sir, book profit would have been 2 CR. And if this 2 CR were divided between 3 partners, 67 lakh were easily appropriable to each partner. Can I say? And also this tax was also leviable to each partner. So can I say tax paid on such transfer? That means capital is 2.57 lakh, 2.57 lakh, 2.57 lakh. Now hold your hands for a second and think what I am saying. Government is saying you are giving this land to Rahul. Okay, no problem. But if this land would have been sold to an outsider, easily you would have paid taxes. Your capital would have been this much. Your capital would have been this much. Your taxes would have been this much. Your taxes would have been this much. Your capital would have been this much. At least you have to pay this much taxes now. At least this much capital gain is leviable in your hand now. At least this much capital is leviable, because if this land would have been sold to an outsider, then this capital gain would have arisen. Then this capital gain would have been definitely taxable in your hands. If everybody agrees with me, then I can proudly say that this is section 9. If such land is sold to an outsider, whatever capital gain is accrued to firm, that will still be taxable under section 9B if such land is given to partner. What I said, I'm just repeating myself. If land would have been sold to an outsider, then whatever capital gain would have accrued at that time, that capital gain is still taxable if such property is given to partner. Because income tax wants to be indifferent. If such property is given to partner, or if property is given to any person, then tax should be same. In that sense, section 9B comes into picture, that this tax will be applicable to partnership firm. Everybody will agree with me. Now, to the extent income tax goes, just be with me. I'll tell you how far income tax goes. Just be with me. What income tax says? What income tax says? If this land were sold to an outsider, again, if this land were sold to an outsider, your partner's capital account could have been your partner's capital account would have been easily this much amount. If this land were sold to an outsider, your profit would have been this much and your tax liability would have been this much. After adjusting these things, your capital would have been 2.57 CR. Everybody, do you agree with me or not? Do you agree with me or not? Yes, sir, we do agree with you. Now comes into picture another section. What section, sir? Law says you are giving Rahul how much? 4 CR. His capital balances, you are for land, or worth of land is 4 CR. You are giving worth of land is 4 CR. Capital balances 2.57 CR. How much excess you are giving against his capital? Just calculate with me. 1.43 CR you are giving access to his capital. Why? If this land would have been sold to an outsider, his capital would have been 2.57 CR maximum. After considering profit, after considering tax, after considering all impacts, his capital would have been 2.57 CR. Why you are giving him asset of worth of 4 crores? Why you are giving him such assets? There is something monetary benefit that he has given to you. Some monetary benefit he has given to you. Pay tax on that monetary benefit. What government is saying? You are paying him 4 crore instead of 2.57 CR. You are paying him 4 CR instead of 2.57 CR. That means he must have given some benefit to you. You are not telling me which benefit. That partner must have given some benefit to you. For that matter, that benefit must be taxable, and this taxability arises in under section 45. This is concept of section 45.4. Did you get this point or not? Because I have to go into much depth than whatever I have told you till now. I have to go into much depth. What we are doing now? We are just taxing. If this land would have been sold to an outsider, then this tax would have arisen, this tax would have accrued, pay tax on that. Then second thing we are doing, Rahul's capital was 2.57 CR, but you are paying more than that. Why you are paying more than that? You are paying more than because some benefit he must have given to you. If you have received any benefit from the partner, pay tax on that. That benefit we are taxing under section 45.4. But intelligent students would find a difficulty in digesting this topic. Why, sir? Why digesting difficulty? Because asset is transferred only once. Only single asset is transferred, but we are paying taxes twice. Can I say? This land is given to Mr. Rahul. This land is given to Mr. Rahul. This land is given to Mr. Rahul. Only this is the case now. But I am being taxed twice. First of all, I am being supposedly, I am being forced to think that this land is sold to an outsider. Pay tax on that. Now I am forced to think that this land is against the capital. This land is much more than capital contributed by him. Ultimately, this land is transferred once now. This land is transferred once. We are not transferring land twice. So why tax it twice? For that, government says, let me tell you the remedy. Government itself says, let me tell you the remedy. This must tax at least is leviable. You have to pay this tax. But we are giving you benefit. We are giving you benefit. What benefit? Government says, since it is reconstitution now, you must have revalued your assets. You must have revalued your assets. So this capital gain will be appropriable, apportioned. This capital gain will be apportioned to different assets that are revalued in ratio of revaluation. In the ratio of revaluation, this capital gain will be apportioned. Sir, how many assets are revalued? So shares are revalued from 2.5 CR to 3.5 CR, and other assets are revalued from 1.5 CR to 2 CR, 2.5 CR. Sir, can I say that two assets are being revalued? Two shares, 2.5 CR to 3 CR, 3.5 CR. Can I say 1 crore revaluation is being done? Other assets 1.5 CR revalued to 2.5 CR. Can I say 1 crore revaluation is done? Can I say 1:1 revaluation? 1:1 is the revaluation ratio. Can I say 1:1 the revaluation ratio is? What this capital gain will be? How capital gain will be distributed? You have to distribute this capital gain in this ratio only. For example, 1.43 divided by 2 is nothing but 7.15. 1.43 divided by 2 is nothing but 0.715. This is the apportioned capital gain to shares. Now, what will I do of this apportioned share capital gain? What will I do? Government says, when in near future, when you will sell these shares now, when you will sell these shares, for example, at 3.5 CR, you are selling. Cost of acquisition was 2.5 CR. You said capital gain will be 1 CR. No, you don't have to pay capital gain of 1 CR. That apportioned capital gain will be reduced from the capital gain calculated later on. Whatever capital gain you will be calculating in future, we will be reducing the apportioned capital gain in the future. Did you get this point or not? Did you get this point or not? That late, whenever we are selling such property again, then any apportioned capital gain will be reduced from so calculated capital gain. This is the provision of section 45(4) and section 9b. I am taking off my specs. I am just reciting whatever I have told you till now. Whenever calculating section 9b and 45(4) at the time of reconstitution, assume the property is being sold to an outsider and calculate capital gain accordingly. Whatever capital gain arises will be taxable under section 9b. As soon as property is being sold to an outsider, what will be the amount of book capital, partners capital, that has to be calculated? How partners capital will be calculated? Original capital before reconstitution. Book profit on the account of the capital gain. Book profit will be sales price minus cost price, and whatever the tax liability is to be adjusted will arise to partners capital just before reconstitution. Now against this capital, we are giving him land of worth 4 crore. That means there is some kind of benefit that partner has given to firm, and that benefit has not been taxed yet. So we are taxing that benefit again under section 45(4). But there is fundamental issue. What fundamental issue? We are taxing same property transferred to single person twice. Property is transferred just once, but we are taxing it twice. There is fundamental issue in that. How to correct it? So for that matter, any capital gain arising under section 45(4) will be apportioned between the assets that are revalued in the ratio in which revaluation is done. And what will we do to that apportioned capital gain? Whenever such assets are being sold in future, any capital gain arising from such capital gain will be reduced by such reapportioned capital gain. Did you get this point or not? There is a very classic example given in book, given in all study materials, and which will help you to understand this concept way better than anybody. I just want your comments. How did you think of this concept? And how did you understand it now? Section 9B, asset distributed to partners on reconstitution and dissolution. See, 9B is applicable when there is dissolution or when there is reconstitution. In both the cases, Section 9B is applicable. Simply, it is applicable when it is reconstitution or dissolution. Reconstitution shall include admission. Reconstitution means admission. Any partner is admitted into firm. Any partner is retired. Any partner died, or there is any change in PSR. It is termed as reconstitution. In case capital asset or stock in trade is distributed by partnership firm to any partner in connection with reconstitution or dissolution of the firm, then distribution shall be deemed to be transferred and pay taxes under the head capital gain or PGBP. As if this property were sold to an outsider, just calculate capital gain and pay taxes to the government. See, capital gain, sales consideration will be FMB, cost of acquisition, index cost of acquisition you have to calculate, and capital gain will arise accordingly. And if any stock in trade is being given, then tax will arise in the hands of the firm under the head PGBP. FMB of the stock in trade minus purchase price will be PGBP income. Any money distributed will not be taxable under the head PGBP, because if you are considering any sales made to an outsider, there is no impact of money given to the partner. There is no concept of money given to the partner while calculating property sold to an outsider. So this point is lesser relevant, but yes, in case of confusion, this will help you out. Section 45(4). Capital asset, money distributed on reconstitution or dissolution of the firm to the partner. When a partner receives any money or capital asset or both in connection with the reconstitution of the firm, then profit arising from the receipt of such shall be chargeable to tax under the head capital gain in the year in which it is received by the partner. Section 9B, Section 45(4) is in addition to Section 9B, and it is taxable in the hands of the firm. That means even if 9B is applicable, 45(4) is still be applicable. So it implies single transfer is taxed twice in the hands of the firm. How calculation is done? Just ignore this part. Just we have to come to an example. We just come to this example. It normally happens. Mr. Prem is a partner in XN Company Mumbai, has 4 partners including Mr. Prem. See, XN Company has 4 partners including Mr. Prem. Profit and share equally 1:1:1:1:1. Not an issue. Prem resigned from XN Company on 1st April 2023. On the said day, capital balance of each partner was 32 lakhs rupees. Okay, no problem. In order to settle the dues of the Prem, the firm revalues its land for the first time since purchase, and valuer also values the sales generated goodwill of 70 lakh rupees. Following capital assets are details as follows. Land at Pune acquired in previous year 12-13 for 15 lakh, revalued at 50 lakh. Land at Nagpur acquired in previous year 15-16 for 254, 25 lakh 40,000, revalued at 45 lakh. Land at Mumbai acquired in previous year 13-14 for 88 lakh, revalued at 250. Sales generated goodwill was 0, now 70. How much revaluation is there? Just calculate 15, 19.6, 162 and 70. This is the revaluation that is being done. In 1st April 2023, XN Company gave land of Nagpur land. Nagpur land is of 45 lakh and 15 lakh. What amount is given? 60 lakh rupees is given to Mr. Prem. Just assume if this land were given to an outsider, how much capital gain would have accrued? If this land would have been given to an outsider, how much capital gain would have accrued? Calculation. 45 lakh would have been sales consideration if this land would have been sold to an outsider. Cost of acquisition will be, index cost of acquisition will be 25.4 lakh divided by CII of 15-16. CII of 15-16 was 254 into 348. It will be 34.8 lakh rupees. So 10.2 lakh would have been capital gain if this land would have been sold to an outsider. What amount of tax would have been accrued to different partners? So 10.2 lakh multiplied by 20% into plus 4% tax liability. Just a second. 212160. This would have been tax liability in the hands of the different partners, also in the hands of the firm. Just let us calculate. Section 9B. Full value of concession 45 lakh. Cost of acquisition 25 lakh 40,000 divided by 254 into 348 will be 10 lakh 20,000. Cost of LTCG will be at the rate 20%, and education says at the rate 4%. Net tax liability will be this and this. Simple topic, simple sir, simple topic. It was easy to calculate the tax payable under section 9. Now concept comes. Now you have to calculate the book value of the partner share, partner's capital. Now just think, partner's capital was 32 lakhs rupees previously. Firm got some kind of gain on account of sale. If this sale would have been to outsider, firm would have gained certain book profits if this property would have been sold to an outsider. Are you understanding? If this property would have been sold to an outsider, then difference would have been accounting gain in the hands of the firm. For example, sir, accounting gain would have been 19.6 lakh. Can I say 19.6 lakh would have been the book profit of the book gain of the firm, and 212160 would have been tax on that. So ultimately, firm would have gained by 17 lakh 47,840, and 1/4 would have been share of Mr. Prem. So his net capital would have been increased by 436,960. Can I say this? Can I say this? His net capital would have been increased by 4,96,000. Simply 19 lakh 60,000 divided by 4, that is book profit. Because of book profit of such transfer, his capital would have increased, and his capital would have been decreased by paying taxes. So all in all, in net, his capital will increase by 4,36,960, which in total will turn out to be 336 lakh 36,960. Can I say his partner's capital before reconstitution will be 36,960? Can I say that his capital before reconstitution will be 36,960? Yes, sir, it will be. Can I say this person, Mr. Prem, is being given 45 lakh rupees land, 15 lakh rupees asset, 60 lakh rupees he is being given against the capital of this? Against the capital of this? Why? Why? There must be some benefit arising from Mr. Prem. Now pay tax on that benefit. How much benefit firm is getting from Mr. Prem? Nothing but 23 lakh 63,040. This is the benefit that firm is getting from Mr. Prem. This is the benefit that firm is getting from Mr. Prem. As simple as it can be. Now, first of all, let us check the calculation. 23 63 040. How things can be difficult. Now, since asset is being given once, but capital gain is being taxed twice, what to do in that sense? Provision wants us to distribute this 23 lakh 63,040 capital gain in the ratio of revaluation. So these three assets are being revalued. Now, in the ratio of 35:162:70, we have to apportion this capital gain in these three assets. How calculation will be done? I have done here. If I am asked how much increase is there, 2.67 crore is the increase. How much increase in Pune land? 35 lakh. How much increase in Mumbai land? 1.62 crore. How much increase in self-generated goodwill? 70 lakh. If I am asked to apportion, then apportionment will come about this and this. Correct. Apportionment will turn out to be this amount. What if Mr. Prem transfers such land to Mr. Rahul for 90 lakh rupees? Mr. Prem received such property for 45 lakh rupees, transfer such property for 90 lakh rupees. Since Mr. Prem already paid tax on that property, Mr. Prem has already paid tax on that property. Why will he pay tax again? So 90 lakh minus 45 lakh will be short-term capital gain in the hands of Mr. Prem. 45 lakh will be taxable. Important question is the next one. Exxon Company, Mumbai transfers the land of Pune for 75 lakh rupees. Land of Pune is costing 15 lakh only. Land of Pune is costing 15 lakh rupees, but it is being transferred at rupees 75. How capital gain will be calculated? Just have a look. 75 lakh will be full value of consideration. 15 lakh will be index divided by 200 into 348. 26 lakh 10,000 will be index cost of acquisition. And I have to reduce apportioned capital gain. Just have a look. Just have a look. Pune land has apportionment of rupees 3.09 lakh rupees. This is the amount of apportionment of capital gain that was taxable when I was taxed section 45.4 under section 45.4. This is the amount of capital gain apportioned to Pune land. Now this apportioned capital gain will be reduced when this Pune land is sold. So in that case, when this Pune land is being sold at 75 lakh rupees and capital gain is calculated, 3.09 lakh is reduced from capital gain so calculated. Did you get this point or not? Yes, sir, we did understand what you are trying to say. We did understand what you are trying to say. Okay, okay, okay. Now let us go through the provision. You need not to read this. Only two things I need to tell. Even you can ignore this part. You can ignore this part. Whatever provisions I have told you for apportionment in the ratio of revaluation, you have to apportion the capital gain. That is the bottom line. That is the bottom line. In the ratio of revaluation, you have to apportion the assets. You have to apportion the capital gain. Now what happens? Just listen. Just listen. Just listen. We are apportioning capital gain to different assets. We are apportioning capital gain to different assets. Correct. This 23 lakh capital gain is being apportioned to different assets. Whether the apportioned capital gain will be long-term capital gain or short-term capital gain. My question is, we are apportioning this capital gain to different assets. Whether this apportioned capital gain will be long-term capital gain or short-term capital gain. Right answer is in these three cases, it will be always short-term, otherwise it will be always long-term. If transfer is on account of short-term capital asset, then this capital gain will be always short-term. If this asset to which apportionment is being made, if the asset to which apportionment is made is depreciable asset, then apportioned capital gain will be short term. And if any apportionment is made on account of goodwill, then apportionment will always be short term capital gain, which means apportioned capital gain on account of goodwill will be short term capital gain and rest both will be long term capital gain. Why is that relevant? For the time being, not relevant. Unless it is being asked to solve in a question, it is not relevant. Just it is for knowledge point of view. For that matter, amount attributed to goodwill is short term and rest both shall be considered as long term capital gain. Did you get this point or not? Yes, sir, we did get your point. Now, since we are done with one of the major portion, the major concept of capital gain, I want you all to have a break of 5 minutes. Do you really need break or should I proceed with the concepts? There are a few concepts that need to be told. Okay, let's complete the capital gain special cases first, then we'll have break. Let's complete the capital gain cases, then we'll have break. Just come to board notes. Share capital 1 CR, reserves 5 CR, cash 1 CR, building 2 CR, shares 3 CR. At the time of liquidation, Rahul Private Limited. At the time of liquidation, first of all, can you all agree with me that liquidation is a transfer? Because rights of the shareholders are being extinguished. Can I say rights of the shareholders are being extinguished? Yes, sir, it is transfer. At the time of liquidation, capital gain is applicable in the hands of the shareholder because his shares are being extinguished. Transfer is applicable in his hand, therefore capital gain will be applicable in his hands. For example, at the time of liquidation, this company distributes assets. This company distributed assets. Sir, how much assets did it distribute? It distributed all 6 CR of assets. All 6 CR of assets. Got this point? Got this point? Company distributed 6 CR worth of asset. Sir, it's FMV were. FMV was FMV was, for example, 10 CR was the FMV. 10 CR was the FMV. 10 CR was the FMV. We are very much familiar with the concept that in case of liquidation, if a company distributes any assets to the extent of accumulated profits, it is termed as deemed dividend. It is termed as deemed dividend. It is termed as dividend. Do you remember? Under section 2, subsection 22, under section 2, clause 22, subclause C, we have studied that in case any company distributes assets on liquidation, so it is termed as deemed dividend to the extent of accumulated reserves. So can I say out of this 10 CR, 5 CR is nothing but deemed dividend. It is taxable under the deemed dividend. Can you all agree with me? Can you all agree with me? Correct, sir, we can agree with you all. How capital gain is calculated here? How capital gain is calculated? Sir, shareholders in again subscribing share capital of 1 CR is getting shares assets of rupees 10 CR. Can I say shareholders against giving share capital of 1 CR are receiving assets of 10 CR. Shareholders on subscribing share capital of 1 crore are receiving assets of rupees 10 crore. Yes, sir. That means full value of consideration or sales consideration will be 10 CR. Cost of acquisition will be 1 CR. Can I say cost of acquisition will be 1 CR? Yes, sir. Cost of acquisition will be 1 CR. Can I say that 5 CR is already taxable under deemed dividend? Capital gain has to be 9 CR. Capital gain has to be 9 CR. But, sir, less deemed dividend because the amount will be taxable under deemed dividend. 5 CR is already taxable under deemed dividend, so only 4 CR will be taxable under the head capital gain. 4 CR will be taxable under the head capital gain. This is how you have to work out the calculation in case of liquidation. Just have a look. Capital asset distributed in case of liquidation. In case of company, for company, there is no transfer. For company, it is not any transfer. But for shareholders, their rights in shares are being extinguished. In the hands of shareholder, how capital gain will be calculated? FMV of the asset received. Whatever assets that shareholders are receiving, you have to consider FMV. Like in our case, 12 or 10 or 12 CR assets were being received by the shareholders. Let me check it whether it was 10 or 12. Yes, assets worth rupees 10 CR are being received by the shareholders. So 10 CR. Less shareholders interest in accumulated profit. Sir, shareholders interest in accumulated profits was 5 CR because 5 CR is taxable in deemed dividend. So that will not be taxable under capital gain. 5 CR shareholders interest in accumulated profits will be taxable under the deemed dividend. So it will not be taxable under capital gain. So 5 CR I have to reduce. And cost of acquisition for the shares was 1 crore. So 4 CR is taxable under that capital gain. This is how liquidation goes. This is how the calculation under liquidation goes. Same question you will see in exam. You will be able to solve easily. Let's come to next portion. There are two concepts, newly introduced concepts, market linked debentures and specified mutual funds. Write a point here. Write a point here. Sir, this provision is inserted to tax certain assets without indexation and tax certain assets as always short term, irrespective of their period of holding. This section is being introduced for taxing such instruments. Till now, two instruments have been notified under this category. What it says: any market linked debentures or specified mutual fund, whenever sold, capital gain accruing from such transfer will be always short term capital asset, short term capital gain, and no indexation benefit will be available in such transfer. Section 50AA clearly states any capital gain arising on transfer of market linked debentures or specified mutual funds will always be taxable as short term capital gain, and no indexation will be permitted in that case. Now question arises, what is market linked debentures and what are specified mutual fund? Let me tell you. I made an agreement with you. I made an agreement with you that I issued debentures not having any fixed coupon interest, fixed coupon rate. I said I will pay you interest based on Nifty. Sir, how Nifty? How Nifty? How Nifty? For example, I issued debentures saying that if I will pay 1.1 times more than growth in Nifty. For example, Nifty increases by 18% in a year. I will be paying you 19.8% return. If Nifty increases by 1%, I will be paying you 1.1% per annum. If Nifty increases by 40%, I will be paying you 44% interest. Getting this is we called market linked debentures. These debentures are linked to market, linked to certain indices, and any capital gain arising from such market linked debentures will always be short term capital gain, and there will be no indexation available. Already we never had any indexation for debentures, but here it is clarifying that any capital gain arising will always be short term capital gain. We have another concept called specified mutual funds. Sir, purpose of mutual fund is to collect the funds from the individual and invest it into different asset classes. Those mutual fund whose not more than 35% is invested in domestic company, equity shares of domestic company, less than 35%, or I should say not more than 35% is invested in domestic shares of the equity company, those mutual funds are called specified mutual funds. Can I say debt oriented mutual funds are specified mutual funds? Can I say debt oriented mutual funds are specified mutual fund? Right answer, it is not appropriate to say that. Every specified mutual fund will be debt oriented mutual funds, but not every debt oriented mutual fund will be specified mutual fund. If you want to classify any mutual fund as debt mutual fund, at least 65%, less than 65% has to be in equity. Less than 65% has to be in equity. But for specified mutual fund, less than 35% has to be in equity. So not every specified mutual fund is a debt oriented. Not every debt oriented mutual fund is a specified mutual fund. There is a demarcation. For section 50AA, we are just studying specified mutual fund whose equity exposure in domestic company is lesser than 35%. And also one thing, issued on or after 1st April 2023. For example, if a mutual fund is issued previous year, if a mutual fund is issued on 1st April 2022, invest only 20% in equity, can it be classified as specified mutual fund? Right answer is no, because it is clearly stated that issued on or after 1st April 2023 will only be classified as specified mutual fund. Any mutual fund issued prior to this date will not be classified as specified mutual funds. Did you guys get this point? Did you get this point? How capital gain is calculated? What are market linked debentures? What are specified mutual funds? How capital gain is calculated? Any sales consideration reduced by transfer expenses? Any net consideration? No indexation. Capital gain always short term. Did you get this point or not? Yes, sir, we did get. We did get what you are trying to say. Transfer of securities held in demat form. What is meant by that? Transfer of securities held in demat form. Sir, let us understand this with an example. I have shares. I have bought shares on 1st April 2023. Reliance, one share at rupees 2700. 1st May 2023, one share at rupees 2800. 1st June 2023, one share at rupees 2900. 1st July 2023, I had a physical share. My father had bought in previous year 1990 at rupees 100. I got it dematted, I got it dematerialized, and costing was rupees 100. That share was bought at rupees 100, so at demat also price will be 100 only. In demat also price will be shown as 100 rupees only. I got this share dematerialized from physical form. On 1st July I did. On 1st August I again bought Reliance at rupees 3000. Now I sold one share of Reliance. What is the price? For example, I sold for 3200. What will be cost of acquisition of such share? Will it be 2700 because it is the first share in the demat account? Will it be 100 because this is the most oldest stock, or will it be average price of these as shown in demat account? Will it be 2500 weighted average method as it is shown in demat 2300 weighted average price? What will be cost of acquisition of this share sold? Will it be 2700? That is the first share entered into demat account. Will it be the first share ever bought, later on dematerialized? Or will it be weighted average price of such shares 2300? The right answer is it will not be 2300, it will not be 100, it will be 2700. Whenever securities are being sold from a demat account, date of entering into account will be always considered while considering their sale. And which method is followed? FIFO method, first in, first out. Whatever shares enters into demat account in first will be taken first while considering cost of acquisition at the time of sale. Even if this share is being bought way back, but this will not be considered for sale unless these three shares are being sold first. The date of entering into account is the most relevant and not the date of buying. Did you get this point or not? Yes, sir, we did understand. We did get this point. There is no issue in this. Okay, good to hear that. Good to hear that. Good to hear that. Good to hear that. Perfect. Sir, what if we have physical shares? What will be cost of acquisition? Arey Baba, physical shares, we already have cost of acquisition in that certificate. If we have physical shares, we do have share certificate, and in share certificate, cost of acquisition is given. So we don't require any physical, we don't require any such method in physical shares. This method is only applicable in case of dematerialized shares. Capitally and applicable in the hands of the beneficial holder, the cost of acquisition shall be decided as per FIFO method. As per CBDT circular, FIFO applies to demat securities and not to physical securities, because physical securities we already have cost of acquisition for every share. And if multiple accounts are held by the SSC, then FIFO should be account wise. If all physical securities are dematerialized, then FIFO should be on the basis of the movement into the account and not the date of the entry into the account. This is a simple concept. Last concept is advance money forfeited. If any advance money is forfeited before 1st April 2014, it is taxable. It is if advance money is forfeited after 1st April 2014, that is after Modi government coming into picture, then it will be taxable under IFRS. But if advance money is forfeited before 1st April 2014, it is to be reduced from cost of acquisition. Sir, how it is reduced from cost of acquisition? Just understand this is with an example. For example, this is Rahul. Sir, bought house in previous year 1-2 at rupees 10 lakh. In previous year 6-7, Mayank gave 25,000 as advance money. But failed to pay balance money. Failed to pay balance money. Previous year 6-7, Mayank gave 25,000 as advance money but failed to pay balance money. Rahul forfeited. Rahul was stunned, so Rahul forfeited. Rahul forfeited such advance money. In previous year, 23-24, Rahul sold such property. How capital gain will be calculated? Sold at, for example, 50 lakh. Capital gain will be calculated, sales consideration will be 50 lakh. Cost of acquisition will be 10 lakh. Sir, 10 lakh reduced by amount of advance money forfeited, that is 9.75 lakh divided by 100 into 348. This is how capital gain will be calculated. $33.93, and ultimate capital gain will arise in my hand will be 16.07. Did you get this point? There were two fundamental issues in this concept. There were two fundamentals. See, advance money was forfeited in previous year 6-7, but government received this advance money in previous year. Government received a tax in previous year 23-24. That means government has to wait for 18-17 years to receive this tax. And even shareholders or even the property holders had an issue. Even property holders had an issue. What issue property holders had? See, property holders were getting cost of acquisition reduced retrospectively. They forfeited advance money in previous year 6-7, but reduction was made in previous year 0-1. So impact of indexation was also indexation was also impacted in that sense. So there were two fundamental issues. Government was receiving tax later on, and shareholders indexation was impacted. So for that matter, as soon as Modi government came into picture, they reduced this concept, they removed this concept, and they directly made advance money forfeited taxable under income from other sources. Last but not the least, most important thing, what if after forfeiting advance money, Rahul gifted this property? Rahul gifted this property to Miss Sweetie. So now capital gain will be applicable in the hands of Mrs. Miss Sweetie. Capital gain will be applicable in the hands of Mrs. Miss Sweetie. Miss Sweetie will sell house for 50 lakh. Cost of acquisition will be 10 lakh as cost of acquisition of the previous owner. Cost of acquisition will be for previous owner. Now, do I have to reduce advance money forfeited? Do I have to reduce advance money forfeited? The right answer is we don't have to reduce any advance money forfeited. For simple reason being, advance money is not forfeited by Miss Sweetie. Advance money is being forfeited by Mr. Rahul. So only the one who is forfeiting the advance money and selling the asset, in that case only cost of acquisition is to be reduced. Otherwise, no cost of acquisition is to be reduced if the if the person forfeiting the advance money is different and person in whose hand capital gain is being calculated is different. In that case, no reduction in cost of acquisition is to be made. Did you get this point or not? This is only written in this case. Advance money forfeited, if forfeited before, reduced from cost of acquisition. If forfeited by the previous owner, then ignore. Forfeited after 1/4/2014, then taxable under income from other sources. These were all your special cases. Take break of 15 minutes. If I'm saying take break, that means seriously you have to take break. You don't have to waste time anywhere. So take break of 15 minutes. After that, I will be completing deduct exemptions, then tax rates, and then at last exempt transfer. I want your full attention because whatever we'll be facing now will not be that easy. It will be taking some time for digestion. So take break wisely. Do not use Instagram. Do not use YouTube. Use it wisely. Correct. See you after 15 minutes. Welcome back. Are you all back from your lunch break or breakfast break, whatever the break you have taken? Are you back from that? I can see, I can vibe with all of you that all of you are back and all of you are very much attentive for the next session or next part of the session, I should say. Where we are right now, I just want all of you to focus on that chart that we had drawn yesterday. Till now, what we have done, we are done with the definition portion. We have done computation portion. We are done with the provisos to section 48, and we are done with full value of consideration. We are done with cost of acquisition also. And the most important portion of the chapter, that is special cases. Part 1, first exception to section 45. And part two, all the remaining special cases that are really very important for exams, we are also done with that. Last but not the least, the most important is exemption and tax rates. Exemptions and tax rates are to be done very seriously. I want all of your attention, at least for next an hour, on these topics so that we can finish it off with good pace and complete clarity. Exemptions under section 54. Sir, there is basic difference between exemption and deduction. Exemption means income that does not form part of gross total income. Incomes that do not form part of the total income. In whatever income we are earning, we get certain type of exemption, and that income does not form part of your gross total income. But if such income forms part of your gross total income but is reduced under chapter 6A or under 10AA, then it is called deduction. Any deduction made below gross total income will be deduction. It will not be treated as exemption. There is minor difference. Here we are studying exemptions from capital gain. What all exemptions are available? Let us understand one by one. First of all, whenever any individual SSC, any individual or HUF, any individual SSC or HUF transfers any residential house property and capital gain on such house property is long-term capital gain, then he can claim exemption on such house property by acquiring another house property. What I said, individual HUF selling residential house property, having long-term capital gain, can get exemption by acquiring another residential house property. Also, if capital gain is up to 2 crore rupees, they can buy 2 residential house property. But this facility, this feature is only available once in lifetime. It cannot be availed more than once. Is that clear? Yes, sir, it is clear. What is the time limit till which property is to be bought? Time limit prescribed by the provision is either it can be purchased a year before the date of sale, or it can be purchased within 2 years from the date of the sale, or it can be constructed within 3 years from the date of the transfer. So if I'm asked to draw it on basis of timeline, if this is the date of sale, either I can purchase a year before the date of sale, or I can buy within 2 years from the date of sale, or I can get it constructed within 3 years. This is the timeline within which the property should be acquired or property should be constructed to get the benefit. Next thing, sir, CGS is applicable. What is meant by CGS? Sir, government wants to track whatever the money that you have received from transfer should be utilized for acquiring new house property. For that matter, how government will track transaction? Government wants you to deposit complete capital gain amount into a special capital gain account scheme where any withdrawals will be traceable. Any withdrawals made from CGS should be used for construction of residential house property or for acquiring residential house property. Otherwise, any misutilization from CGS account will render such a scheme invalid, and then exemption will be withdrawn. Sir, how much exemption is available? Government simply says any cost of new asset. Whatever the amount of cost of new asset is will be available. For example, sales consideration is 1 CR. Cost of acquisition, index cost of acquisition was supposed 50 lakh rupees. Capital gain is 50 lakh rupees. I deposited nearly 40 lakh rupees in CGS account. Amount. What will be the capital gain? Provision says, first of all, you have to check whatever the cost of new asset is. For example, I bought asset for rupees 45 lakh rupees. It can be either cost of new asset. It can be either capital gain. Capital gain was 50 lakh. It can be either amount deposited to CGS 40 lakh or 10 crore, whichever is lower will be allowed as exemption. In this case, lower is CGS, so amount of exemption will be 40 lakh. Did you get this point or not? Yes, sir, we did get this point. Also, there is lock-in period. Once you have constructed the house property, acquired any house property, you cannot sell that house property for at least 3 years. In case you sell that house property, any exemption claimed will be withdrawn, or I should say that any exemption that you have taken will be reduced from cost of acquisition at the time of subsequent sale. Sir, what I am saying, just listen to this. This example. For example, sir, I had made a house a transfer for 50 lakh rupees. Cost of acquisition was 25 lakh rupees, and sir, capital gain was 25 lakh rupees. I took exemption of rupees 20 lakh. I took exemption of 20 lakh rupees and I paid taxes on rupees 5 lakh. I paid taxes on 5 lakh. Now what happened was I bought a new house. I bought a new house for rupees 20 lakh rupees. I bought a new house for rupees 20 lakh rupees. Now, what will happen if I sell this new house within 3 years? Then what will happen? Then what will happen? The exemption claimed earlier will be withdrawn. How it will be withdrawn? Just listen to this. What if I sold this house within 3 years? For example, I sold this house for 50 lakh rupees. Now, what will be the capital gain computation? Sales consideration will be 50 lakh. Cost of acquisition will be 20 lakh, but government says, provision says that while computing capital gain of the subsequent sale, you have to reduce it from the cost of acquisition. Whatever the amount of capital, whatever the amount of deduction that you had earlier claimed has to be reduced from cost of acquisition at the time of subsequent sale. Therefore, cost of acquisition will become nil, and ultimately you have to pay taxes on the further sale. In case of further sale, any deduction claimed earlier shall be reduced from cost of acquisition from the at the time of the transfer. Did you get this point or not? Did you get this point or not? Yes, sir, we did get this point. What if, sir, I have told you, I have told that you can buy one residential house property within 2 years, or you have to get it constructed within 3 years. What if I bought one flat and another adjacent flat, a flat adjacent to it, and made it one? I broke the inner walls, I constructed gate within, and adjoined both the flats together. I bought different flats with an intention to make them one. Can I say I have bought single flat? I have bought different flats with sole intention of making it one. Can I say I have bought single flat? Right answer is yes. Even if you have bought through different people, even if you have bought on different sale deeds, even if the sale or purchase consideration is different, in all the cases it will be considered as same flat if inner lining has been withdrawn and the flat becomes adjoined. In that case, it will be considered as one flat only. Sir, flat construction costs include cost for land and building. It is as simple as it can be. If you want to get the house constructed, any amount paid for construction or any amount paid for acquisition of land, for acquisition of building will be a part of cost, will be a part of exemption. And what if, sir, what if I want to buy a house? I want to claim exemption. For that I have to buy the house. I want to buy the house, but what I want to buy a house in the name of my mother. Is it possible to buy a house in the name of mother? Right answer is it is very much possible. It is possible. So will I be eligible for exemption? Just tell me this case. Just tell me this case. I sold an house. Capital gain was in my hand. I took exemption. Now I have bought new house, but I want to register this house in name of my mother. Is it possible to get that registered? Yes, sir. It is very much possible to get house registered in the name of mother. Will I still be eligible for the exemption? Right answer is yes. If you have paid the consideration, even if registry is in the hand of the other person, you will still be eligible for exemption. You will still be eligible for exemption. This was all about section 54. This was all about section 54. Next section is section 54B. If any individual or HUF transfers any urban agriculture land which is used by him or his parents at least for 2 years for the purpose of agriculture. Individual HUF transferring urban agriculture land used by them for at least 2 years. Long-term capital gain, it can be long-term capital gain, it can be short-term capital gain. You all must be wondering if they have used for 2 years, how can it be short-term? You all must be wondering if they have used for 2 years, how can it be short-term? Right answer is they might have been tenants. If they were tenants and used for more years and they acquired it a year back, it can still be short-term. Yes, sir, it can be short term. So what I am saying, any individual HUF transfers any urban agriculture land which they have used for 2 years, long-term capital gain or short-term capital gain irrelevant, and acquiring any urban agriculture land or rural agriculture land. They can acquire any urban agriculture land or rural agriculture land. Sir, within 2 years they have to buy. From the date of the transfer, within 2 years, they have to buy and they have to deposit the amount to CGS up to the date of return filing so that government can track whether they are using money correctly or not. In that case, your capital gain will be exempt. How much capital gain will be exempt, sir? Cost of new asset, amount deposited to CGS or actual capital gain, whichever is lower, will be exempt in this case also. Again, lock in for 3 years. Once you have bought the rural agriculture land or urban agriculture land, you have to keep that land for 3 years. Otherwise, any amount withdrawn or any further sale made within 3 years shall shall cause reduction in cost of acquisition at the time of sale. Shall cause reduction in cost of acquisition at the time of sale. Okay, so this was all about this. Sir, what if I have urban agriculture land and I sold it and claimed exemption and bought rural agriculture land? I have urban agriculture land, claimed exemption, bought rural agriculture land, correct? Can I do that? Yes, I can do that. What if I sold this rural agriculture land within 3 years period? Will capital gain be still leviable in my hands? Right answer is no. Why, sir? Why not? Why capital gain will not be leviable? Because, sir, rural agriculture land is not a capital asset. Did you get this point? If you have urban agriculture land, you sold that land, any capital gain arising, you bought any urban agriculture land, you cannot sell it for 3 years. But after selling urban agriculture land, you can buy rural agriculture land. And if you bought rural agriculture land, lock-in period does not apply because rural agriculture land is not a capital asset. This is the kind of tax planning that many a times question asks. Therefore, it has been noted in this study made. At this point, okay, sir, we did understand. Section 54D. 54D is very less relevant. What it says, any person. It does not differentiate between individual SSC or company SSC. It says any person whose land and building for industrial undertaking has been compulsorily acquired. Land and building of an industrial undertaking has been compulsorily acquired, and those lands and building have been used by such SSC for at least 2 years. Any long-term capital gain, short-term capital gain will be exempt if they acquire new land and building for industrial undertaking. What I said, any SSC whose land or building has been compulsorily acquired, industrial land or building has been compulsorily acquired, which was used by them at least for 2 years. Any long-term capital gain, any short-term capital gain will be exempt if they buy any kind of new land and building for industrial undertaking. Within how much period it should be bought? Provision says it should be bought within 3 years from the date of receipt of the compensation. As soon as you receive compensation, you have to buy it within 3 years. You have to buy it within 3 years. Sir, CGS applicable? Yes, sir, CGS is applicable. What is the amount of exemption? Cost of new asset. What will be the cost of new asset? Or, sir, capital gain? Or, sir, or what it says, CGS, amount deposit to CGS. Whichever is lower will be the capital gain exemption. Again, sir, lock-in period remains same. You have to keep that land or building at least for 3 years. Otherwise it will be reduced from cost of acquisition at the time of further sale. Very important, section 54 EC. This is the only section for tax planning available for companies. Just remember this point. Because if a company wants to save their taxes on sale of any immovable property, they don't have any other option other than section 54 EC. They don't have any other option. Simply, they don't have any other option. If they transfer any land or building, or both, any immovable property, you can say, any immovable property they transfer, which is a long-term capital asset, and capital gain arising from such capital asset is long-term capital gain, then they can get exemption. They can get exemption up to 50 lakh rupees if they invest in 5-year redeemable bonds of NHAI, National Highway Authority of India, Rural Electrification Corporation Limited, Power Finance Corporation Limited, and Indian Railway Finance Corporation Limited. They can invest in bonds of any of these 4 companies. So maximum 50 lakh rupees exemption will be allowed to them. Two things to be taken care of. Bond are of 5 years. During this 5-year tenure, you cannot sell these bonds, nor you can convert it into money. Sir, what is meant by convert into money? Convert into money means you cannot mortgage such bonds and take loan against it. You cannot take that. Ultimately, you cannot encash that bonds in any form. If you encash that, whatever amount that you are encashing will become taxable in your hands. Did you get this point or not? Sir, after sale, after transfer, within how much time we have to acquire such bonds? Provision says you don't have to wait for 3 months. You don't have to wait for 1 year, 2 year, 3 year. Just 6 months. We are giving you 6 months. You have to buy such bonds within 6 months. But CGS is not applicable, sir. You don't have to deposit any money in CGS. You can directly invest in bonds within 6 months from the date of the transfer. Sir, how much exemption is allowed? Sir, simply capital gain. Cost of new asset can be simply the amount of invested in bonds, maximum 50 lakh rupees. Cost of new asset, no CGS. Ultimately, cost of new asset, capital gain, or 50 lakh rupees, whichever is lower, will be allowed as deduction. So if bond is transferred within 5 years from the date of acquisition or converted into money, then it shall be taxable in the year of violation. Sir, what if we made payment to acquire bonds within 6 months? What if we made payment to acquire bonds within 6 months, but bonds are not allotted to us? Because of issues at the company's end, bonds are not allotted to us. Is it our fault that our exemption will be denied? Right answer is it is not our fault. It is fault at the companies and we paid our money within 6 months. So are we eligible for exemption? Right answer is yes, sir, we will be eligible for exemption. If it is company's issue, we will be not the one to be blamed at. We will be still allowed exemption if we have paid money within the period of 6 months. It is important case law. This case law was evidenced in case of VS Dempo, Supreme Court. What case it says? Normally what we have studied is long-term capital assets renders long-term capital gain and short-term capital asset renders short-term capital gain. This is the general rule. Long-term capital asset renders long-term capital gain, short-term capital asset renders short-term capital gain. What if I say that capital asset was long-term, but it was depreciable asset? Capital asset was long-term, but it was depreciable asset. Is it possible to have a depreciable asset as long-term asset? Yes, sir, it is possible. We have been having building for 10 years in our business. It is a depreciable asset. It is a long-term asset. Can you tell what type of capital gain will be having if we are selling any depreciable asset? Right answer is short-term capital gain. Any depreciable asset renders short-term capital gain. We are very much aware. So is it possible any long-term capital asset can render short-term capital gain? Right answer is yes. In case of depreciable asset, even if asset is long-term capital asset, depreciation capital gain will be short-term. What if I sold a building? I sold a building held in business for 10 years. Can I get exemption under section 54 EC? Can I get exemption under 54 EC? Sir, capital asset is a long-term capital asset, but capital gain is short-term capital gain. Can I claim exemption against such capital gain by investing in bonds under section 54 EC? The right answer is Supreme Court of India in case law of VS Dempo Limited said that it is more important to have capital asset as long-term capital asset because short-term capital gain is the such capital gain. Short-term capital gain is the nature of the capital gain, but asset was long-term. You held it for a longer period, so it was long-term capital asset. Therefore, exemption will be still allowed in that case. Exemption will still be allowed in that case. Therefore, you will still be allowed exemption. In case of depreciable asset being long-term capital asset and gain being short-term, it is still eligible for section 54 EC. All written in just one line. It is very later that you will realize the value of this book. Not now, but later on you will realize the value of this book. Last, section 54F. This is a bit different. What it says. If any individual or HUF transfers any long-term capital asset other than residential house property. Sir, any long-term capital asset other than residential house property, what can it include, sir? It can include shares. It can include any kind of gold. It can include any land. Sir, land shall also be a part of section 54F. If you are selling any land or you are having any long-term capital gain in sale of land, it will be still exempt under section 54F because it is not residential property. Land is not a residential property. Any long-term capital gain and capital gain is long-term capital gain. Any long-term capital asset other than residential house property and sir, long capital gain is long-term capital gain. Sir, if it shall be exempt if we acquire any one residential house property in India. What I am saying, any individual HF transfers any capital asset other than residential house property and long-term capital gain is long-term capital gain. That capital gain will be exempt if he acquires one residential house property. What is the time limit for acquisition? Right answer is sir -1 +2 +3. It can be acquired either a year back from the date of the transfer. It can be acquired within 2 years from the date of the transfer, or it can be constructed within 3 years from the date of the transfer. This is the date -1 +2 +3. Sir, whether CGS is applicable? Yes, sir, from the day CGS is applicable. Whatever the amount of capital gain is or amount of net consideration, you have to deposit it into CGS account to the date of return filing. What is the amount of exemption? Here, amount of exemption is a bit different. What it says, just listen to this. Capital gain multiplied by cost of new assets divided by net consideration. This provision says we don't give exemption based on your capital gain. We give exemption based on your net consideration. Out of your net consideration, how much of such net consideration you are using as for acquiring new asset? Out of that net consideration, how much of that net consideration you are using for acquiring new asset? In that proportion we will be exempting your capital gain. For example, sir, sales consideration was 50 lakh rupees. Cost of acquisition or index cost of acquisition was nothing but 25 lakh rupees. Capital gain was 25 lakh rupees. Now I bought a new house. For rupees 40 lakh. Provision says capital gain will be exempt in the proportion of net consideration and net consideration of cost of new asset. That means out of net consideration of 50 lakh rupees, you are using 40 lakh to acquire new asset now. So in that proportion only we will be exempting this capital gain. So your exemption will be 20 lakh rupees. Exemption will be 20 lakh rupees and still taxable amount will be 5 lakh rupees. Did you get this point or not? Did you get this point or not? Yes, sir, we understood this point. Sir, again, you have to take care of lock-in period. Once asset is bought, it should be held for at least 3 years. Otherwise, whatever amount you have taken for deduction or you have claimed exemption will be taxable in the year in which violation took place. Sir, what if I sold a house and bought in joint ownership? Consideration is being paid by me, but I gave half ownership to my wife. Is it possible to give half ownership to my wife? Yes, it is possible. I sold house myself, bought house myself, but I got registered it for both of us. Is it possible to claim exemption whole on my part? Yes, it is possible. Sir, it was also evidence in one of the case law. Property bought in the joint ownership and one joint owner paid full consideration. It is allowed for whole of that exemption will be allowed for that individual. Sir, what if we are asked to get house constructed within 3 years? What if house is almost constructed, a few of floorings, a few of fittings, pipes, wires are pending, rest all completion or rest all work is done, only a few portion is left, wiring, fitting, these are a few mechanical works are left. Can I say construction is incomplete? Right answer is it is deemed that construction is complete. Exemption will still be allowed if within 3 years all work is done except for a few flooring work or except a few regular works. Leave third one. Says he should not hold more than one residential house property at the time of claiming exemption. When you are claiming exemption under section 54F, you can only have one residential house property, and in addition to that you are buying new residential house property. It should not be the case you already have to. If you have to, you will not be allowed for any exemption. Did you get this point? Did you get this point? And one more thing, residential house property in both the cases under section 54 and under section 54F should be in India. You cannot buy any house property in Dubai or in any other country. You have to buy that property in India. Now there was a case law. Case law, what was the case law? Just listen to this. Sales consideration of the house was, for example, 50 lakh rupees. Cost of acquisition was 20 lakh rupees. Capital gain was 30 lakh rupees. This was the instance. But AO was not satisfied with sales consideration. He took SDV as sales consideration and SDV was 670 lakh rupees. And he computed capital gain of rupees 50 lakh rupees. He computed capital gain of 50 lakh rupees. Correct? Now this SSC went to claim exemption of this 50 lakh rupees. He bought a house of rupees 60 lakh rupees. Just assume he bought a house of rupees 60 lakh rupees. His old house was sold for 50 lakh, but deemed consideration was taken as 70 lakh rupees. Under section 50C, deemed consideration or net consideration or full value of consideration was considered 70 lakh rupees because SDV was this much. He bought a new house of rupees 70 lakh rupees. Now he wants to claim exemption for that 50 lakh rupees. How can he claim exemption? Sir, capital gain multiplied by cost of new asset divided by net consideration. Here net consideration was, sir, for the purpose of calculation, net consideration will be 70 lakh rupees. Net consideration will be 70 lakh rupees. And cost of new asset will be 60 lakh rupees. This is where AO caught the SSC. Now AO said this. How can you spend 60 lakh rupees when your actual consideration was 50 lakh rupees? How can you claim exemption on the amount that you are bringing out of the pockets? AO here claimed that how can you claim exemption on 60 lakh rupees? How can you say that cost of new asset is 60 lakh rupees? When you got money of rupees just 50 lakh rupees, you are additionally putting 10 lakh and claiming exemption. Is it allowed? Supreme Court said yes, it is allowed. Yes, it is allowed. Whenever SDV is taken as full consideration, full value of consideration. Yeah, SDV is taken as sales consideration. In that case, cost of acquisition or cost of new asset can be greater than net consideration, and still exemption will be allowed on such increased part. It is not relevant whether he is bringing out of pockets, either he is looting somewhere. It is not relevant. It is relevant that it has to be lesser or it has to be equal to net consideration. Whether it can be SDV or it can be actual consideration, it has to be lesser or equal. It cannot be more than that. Did you get this point or not? What AO's contention was, how can you say that cost of new asset is 60 lakh rupees when your sales consideration was just 50 lakh? For that, Supreme Court said that he brought money off his own pocket. Why you have an issue? This case law was Goli Mahadevappa's case law, Goli Mahadevappa, where Goli ji said, I am bringing 10 lakh rupees out of my own pockets just to reduce this tax burden so that my tax shall be reduced. In that case, Supreme Court allowed this person to claim exemption on money brought out of his own pockets. Okay. These were basic exemptions that you must be aware of and you are already aware of. Now, a few special exemptions. What it says, Section 50G and 50GA. Any eligible SSC, say any eligible. We will be studying both of them simultaneously. Any SSC, any person. Asset transferred are land, building, plant and machinery of industrial unit of urban area, land, building, plant and machinery of industrial unit of urban area. Till now, no difference. What type of capital gain? Long-term capital gain, short-term capital gain. Wow. Nice. Asset to be acquired. Wait for a second. Within 1 year or 3 years from the date of the transfer? Within 1 year from the date of the transfer, no difference. Exemption limit, capital gain, amount invested or cost of new asset, capital gain, amount invested in CGS, cost of new asset, oh, no difference. Login period 3 years, no difference. Only difference is asset to be acquired. Sir, what it says? Purchase or construction of new plant and machinery in rural area. It says 50G says from urban to rural you have to go. Urban or rural you have to go and you have to buy new plant and machinery. From urban area to rural area you are shifting and you have to buy new plant and machinery. Whereas section 50G says purchase construction of plant and machinery in SEZ area or shifting to SEZ area. It says urban to SEZ area and it does not say new. It says you have to use plant and machinery. Sir, is second-hand plant and machinery allowed? Yes, second-hand plant and machinery is also allowed. Second-hand plant and machinery is also allowed in this case. So did you find the difference? Sir, in this case, urban to rural we are shifting and no second-hand plant and machinery is allowed. But in 50GA, from urban we are shifting to SEZ and we have second-hand plant and machinery allowed. Also, one thing I want all of you to focus. On one thing. One thing that I think you all are missing in this point. What if furniture is being transferred? Do we get exemption on furniture also? Do we get exemption on furniture also? I'm waiting for all of you to answer. I can sense your answers. Right answer is any capital gain arising from the transfer of the furniture from urban area to rural area will still not be exempt. It will not be exempt under this section. Did you get this point? We do have a question in study material. We do have a question in our question bank where you will find this, that furniture was transferred and no capital gain was exempted in that case. Sir, advance given for land and building, plant and machinery for the utilization of the capital gain will still be allowed. CGS, capital gain accounting scheme, if any investment is not made under section 54, 54B, 54EC, 54F, 54, 54GA, the duty of return filing or net consideration under section 54F, has to be deposited in CGS, and amount so deposited shall be deemed to be new asset up till new asset is bought. If amount is not fully utilized, then proportionate amount shall be taxable. Sir, if you are not able to utilize CGS balance properly, then balance amount will be taxable in your hands. Section 1037, it is very basic section. See, what happens is when Andhra Pradesh got split up and Telangana was created, so capital Hyderabad was shifted to Telangana. Now Andhra Pradesh want to develop its capital. For development of its capital, it chose area called Amravati. Now, Amravati was a village. People used to live in a very small buildings, old wooden structures. Now, government want to develop that property. Now, if government wants to develop that property, how can it develop that? They have to remove such people. Now, if they have to compulsory acquire the property of such village people, it will amount to transfer. Now, just imagine a village person whose property is being acquired by the government. Compensation will not be even paid to the to those people. Is it legible enough? Is it good enough to see capital gain? So, to reduce any tax liabilities or to reduce any tax burden to the people of Amravati, following transfers will be exempt transfers. Just listen to what I am saying. Any land or building owned by SSC on or before 2nd June 2014, compulsorily acquired by the government under land pooling scheme will be exempt transfer. Acquisition by the government will be exempt transfer. Against that land, they were awarded land pooling ownership certificate. These certificates would entitle them to acquire any flat as soon as city was developed. So allotment of LPOCs was made to them. Against their property, they were allotted LPOCs. Now, just imagine if a poor person who does not have any property, who cannot have any rented premises, either he will be selling these LPOCs to get out some money. To get some money, he will be sending such LPOCs. So, government said any sale of LPOCs by the landowner will also be exempt. Any sale of LPOCs by the landowner will also be exempt. But if property is allotted to such landowner, any transfer of such property within 2 years from the end of the year in which allotment is made will also be exempt. What I said, if property is allotted, let the year end, and 2 years from the end of the year, if you transfer such allotted property, it will still be exempt. But if you transfer after this period, then cost of acquisition will be FMV as on the date of the end of this 2 year. Did you get this point or not? At any point you are allotted this property, let the year end, let 2 years end. During this period, if you sell this property, capital gain will not be applicable in your hands. And if you sell it afterwards, capital gain will be applicable. Sales consideration will be your sales consideration, but cost of acquisition will be FMV on the date, on FMV on this date. FMV on the end of the second year will be considered as cost of acquisition. Did you get this point? Very basic question, very least likely to come. Next, we have section 1037. Section 1037 says any urban agriculture land. If any urban agriculture land is compulsorily acquired and compensation is paid by RBI, any urban agriculture land is compulsorily acquired and compensation is paid by RBI, and it is used for agriculture purpose at least for 2 years, then it will be exempt. Any compulsory acquisition of urban agriculture land, compensation paid by RBI and used for 2 years will be completely exempt. Did you get this point or not? Yes, sir, we did get this point. Okay, this was all about exemptions. Now we are done with exemptions portion. Now we have capital gain. First of all, we need to understand tax rates. Let's mark first, because this is more important step. Tax rates and capital gain. All of you are aware of this basic tax rates. Sir, for securities mentioned under section 112A, long-term capital gain, sir, capital gain will be leviable at the rate 10% over and above the capital gain of 1 lakh. For example, if we have capital gain of 1.1 lakh, so tax will be levied on 10,000 rupees at the rate of 10%. If capital gain is of 10 lakh rupees, tax will be levied on 9 lakh over and above 1 lakh rupees at the rate of 10%. For any capital gain mentioned under section 111A, tax will be levied at 15%. For any other short-term capital gain, slab rate will be applicable, or for any capital gain under section 112, 20% will be applicable. We will be studying about every section in detail. Need not to worry, need not to hurry. Section 112. The long-term capital gain on certain assets. First of all, there has to be long-term capital gain, and second, only a few assets are covered under this section, not all the assets. What it says, just listen. Any equity shares, any units of equity-oriented mutual funds, or any units of business trust. Any equity shares, any equity-oriented mutual funds, or any units of business trust on which STT is paid on acquisition and transfer. On which STT is paid on acquisition and transfer. STT is paid on acquisition on transfer. Normally, on which assets STT is applicable? STT is applicable on listed securities. So can I say equity shares that are listed, or equity oriented mutual fund that are listed, or business trust unit that are listed? So only listed securities will be covered under 112A. Listed shares, listed equity oriented mutual funds, and listed business trusts. So listed units of business trust will be covered under section 112. What will be applicable tax rate? Applicable tax rate will be 10% beyond the gain of 1 lakh rupees. That is up to 1 lakh rupees, it is exempt. Sir, what if STT is not applicable? Is it necessary for STT? Is it necessary that STT has to be paid always? Right answer is, there are two cases in which STT is not applicable. There are two cases in which STT is not applicable. First one is, what if, sir, STT was not even introduced? STT was introduced on 1st October 2004. If asset is acquired before that, how can you pay that? How can you pay STT? Therefore, STT will not be applicable if asset is acquired before 1st October 2004. And second case, the cases where STT is not applicable. For example, if you buy ESOPs from the company, will STT be applicable? Right answer is STT will not be applicable. So in these two cases, even if you have not paid STT, you will still be eligible for deductions. You will still be eligible for this concessional tax rate under section 112. But there are three cases. There are three cases. In cases where even if you pay STT now, you will still be not eligible for 112. Even if you are selling listed equity shares, even if you are selling listed equity oriented mutual funds, or even if you are selling listed units of business trust, you are paying STT, but you will still not be eligible for 112A. Sir, what are those three cases? Do brief us. What are those three cases? What if you bought such shares? What if you bought such mutual funds? What if you bought such units of business trust from a non-recognized stock exchange? You bought it from Delhi Stock Exchange, you bought it from Kolkata Stock Exchange. Is it possible to buy from them? Is it possible to buy from them? Yes, sir, it is possible to buy from them. In case you have bought it from non-recognized stock exchange or a place other than recognized stock exchange, you will not be eligible for benefit under section 112A. But these class of people will still be eligible for exemption even if they have not bought from recognized stock exchange. What are those people? Sir, if on account of Supreme Court's order, High Court's order, NCLT's order, SEBI's order, shares are being bought, or they are being acquired by ESOPs, or they are being acquired by non-resident as per FDI guidelines, or they are being acquired as per SEBI regulations, or they are being acquired from any government. In these cases, even if they are acquired other than recognized stock exchange, they will still be eligible for 112A capital gain tax rate. Second case where even if you pay STT, you will still not be eligible for 112A tax rate. Second case is, you bought shares that are not frequently traded. You bought shares which are not frequently traded. Even if you pay STT, you will still not be eligible for 112A tax rate. But these few people, even if they buy shares that are not frequently traded, still be eligible for 112A. What are those people? Who are those people? Sir, qualified institutional investors. Person buying on behalf of order of NCLT, or on behalf of order of RBI, or on behalf of order of SBI, on behalf of SEBI, or on behalf of any investment fund. These people, even if they buy those shares that are not frequently, they will still be eligible. They will be eligible for 112A capital gain. And third one, a case where even if you pay STT, you will still not be eligible for 112A if you buy shares that are delisted and are on a process of relisting. intervening period between delisting and relisting. If you buy shares in between that, even if you pay STT, you'll still not be eligible for 112A benefit. So what I said, 112A benefit is available for listed shares. For shares to be listed, you have to pay STT in both the cases. But STT is not available in two cases. What are two cases? If shares are acquired before 1st October 2004, or STT is not available, for example, ESOPs. But in these three cases, even if you paid STT, you will still not be eligible for 112A. But for example, if you bought shares that are not frequently traded, but in these cases, even if shares are not frequently traded, you still be eligible for 112A. For example, if you bought on account of SEBI order, NCLT order, RBI order, or any other order. In case you bought shares from other than recognized stock exchange, even if you pay STT, you will still not be eligible for deduction, concessional rate under section 112A. But these few people will still be allowed. Sir, sir, ESOPs, any person buying shares on ESOPs, or any person buying from government, any person buying on account of slum sale, any person buying on account of FDI guidelines, any person buying on account of SEBI regulations, any acquisition made under this section, even if not made through recognized stock exchange, will still be eligible for 112A. And last one is any person buying shares between delisting period and relisting period will still be eligible for will not be eligible for 112A tax rate. Hope things are really very clear. So till now we have understood what will be the tax rate. What will be the tax rate? Now we need to understand what will be the cost of acquisition for such securities. Cost of acquisition for such securities, government says, see, we need to understand, we have to remember a date. The date is 1st Feb 2018. 1st Feb 2018, it was the date in which capital gain tax was introduced. Long-term capital gain tax was introduced on 1st February 2018. For that matter, we have to remember 31st January 2018. Arun Jaitley said, any asset which is covered under section 112A, its cost of acquisition will be actual cost or fair market value as on the date 31st January 2018. Did you get this point or not? Any shares, any securities that are covered under section 112A, its cost of acquisition will be taken as follows. Sir, how cost of acquisition will be taken? You have to focus here. Focus here for a minute. This is a trickier point. You might miss this if you do not hear. Just give me a second. You might get confused. What I am saying is, you have to compare actual cost of securities, or lower of FMV as on 31st January 2018, or sale value, whichever is lower. Lower of, you have to compare with higher. What it says, you have to compare FMV with sales, whichever is lower, and the lower one you have to compare with cost of acquisition, whichever is higher, you will acquire the cost of acquisition. There is in-depth concept in that. I have told, because of budget issues, because of introduction of long-term capital gain, we are given this cost of acquisition, or we call it grandfathering value. We are given this grandfathering value because introduction of long-term capital gain. And because of such grandfathering value, nobody should be allowed excessive loss. Therefore, the sales word is also included in this cost of acquisition concept. By putting numbers in these three figure places, you will find out the cost of acquisition. You will get the cost of acquisition. Now, important term is, what is fair market value? What is fair market value? What is FMV, sir? How will you calculate FMV of shares? How will you calculate FMV of units of business trust? Or how will you calculate FMV of equity-oriented mutual funds? Simply provision says, if these shares, if these mutual funds, or if these units of businesses are listed on that day, if these are listed on 31st January 2018, take the highest traded price, not the average, not the lowest, highest traded price, because you have to take cost of acquisition now. You have to take highest traded price as on 31st January 2018. Whatever be the highest. I want all of you to draw a skull over here, because I think you are going to confuse between highest or lowest or average. You are going to confuse. So for that matter, For that matter, mark highest as really very important, because otherwise you will end up doing calculations with average figures. So don't do mistake in that regard. What I said, how to calculate FMV. If shares, mutual funds, or business of units of businesses are listed on 31st January 2018, take the highest traded price. If there is no trading done on that day, take the highest price of the last day on which trading has been done in those shares. Take those values. But what if shares or units or mutual funds are not listed? For mutual fund, take NAV as on the 31st January 2018. NAV. We have studied NAV in AFM. But if shares or businesses are not listed on 31st January 2018, how will you take that? How will you take that? You will take cost of acquisition, actual cost of acquisition, divide by CII of the year of acquisition, or multiplied by CII of year 1718, that is 272. This will give you index cost of acquisition, or FMV, as on the date of 31st January 2018. Did you get this point? Did you get this point? So what I am saying, just focus on what I am saying. Just your focus should be here. Your focus should be here. What I am saying, whenever you are selling any securities under section 112A, cost of acquisition has to be taken, sales price or FMV, whichever is lower, compared with cost of acquisition, whichever is higher. Sir, what is FMV? If shares, mutual funds, or businesses are listed as on 31st January 2018, you have to take the highest traded value. If shares are not traded, take the highest trading value of the preceding date on which trading was done on such shares. But what if shares, mutual funds, or trust units are not listed? For units of mutual fund, take NAV. But for shares and businesses, what will you do? You will take cost of acquisition divided by CII of the year of acquisition, multiply by CII of the year of 1718, that is 272. So with that, you will get index cost of acquisition as on 31st January 2018. Sir, what if shares were purchased before year 2001? Take FMV and divide by 100. Take FMV as on 1st April 2001 divided by 100, multiplied by 272. I hope things are very much clear. Sir, now the point is, what is equity oriented mutual funds? What is equity oriented mutual fund or a ULIP? Sir, what is equity oriented mutual fund? Sir, what equity oriented mutual fund is? Any mutual fund which invests at least 65% of its proceeds in listed shares of domestic company. Any mutual fund which invests 65% of its proceeds in listed shares of domestic company is a equity oriented mutual fund. Or there is another form of equity oriented mutual fund. Sir, what if I directly don't invest? I invest, sir, a mutual fund invests in another mutual fund, and such mutual fund invest, sir, in listed shares of domestic company. For that matter, what percentage has to be looked? At least 90% of your proceeds should be invested in a listed units of mutual funds, and such other mutual fund shall invest 90% of its proceeds in listed shares of domestic company. For that matter, it will be considered as equity oriented mutual funds. Did you get this point or not? Did you get this point or not? Sir, what is equity oriented mutual fund? Sir, any mutual fund which invests at least 65% of its proceeds in listed equity shares of the domestic company, or any mutual fund which invests at least 90% of its proceeds in another mutual fund which is also listed, and such other mutual fund invests at least 90% of its proceeds into listed shares of domestic company. Got this point? Got this point? If you are having any doubt, if you are facing any difficulty, see, we are revising these things. I have to expect at least some basic knowledge from all of you. So if you are facing any difficulty, you are thinking things are going a bit fast, do message me out. I will slow things down at that pace. Or if you think that you are not able to grasp anything, you can ask me personally. I am very open for doubts. You can ask me anytime. Correct? Okay, sir. Okay. Now we have come to section LTCG, STCG 11, section 111A. Section 111A says any equity shares, any equity oriented mutual funds, any units of businesses on which STT is paid. I have heard these things. I think I have heard these things. Sir, these are same securities that are covered under section 112A. These are same securities that are covered under 112A. So what it says, any securities that are covered under section 112A are the same securities covered under section 111A. If period of holding is greater than If period of holding is more than for long term, then capital gain under section 112A will apply. But if period of holding is for short term, then capital gain under section 111A will apply. Will be taxable at the rate 15%. But even if STT is not paid in recognized stock exchange in IFSC, then in that case, still exemption will be available. Lower tax rate will be available. Other STCG, no issue whatsoever. Any other STCG will be taxable at normal tax rate. For example, you are selling gold and it is short term, normal tax rate. You are selling building, short term, normal tax rate. You are selling unlisted shares, short term, slab rate. If you are selling any depreciable asset, short term, simply slab rate. You don't have to think anything. Last is LTCG 112. Focus has to be here. Focus has to be here. In case of LTCG other than LTCG 112, every long-term capital gain other than 112, 112 says for listed equity shares, listed mutual funds, and listed equity-oriented mutual funds, and listed units of businesses. Any other assets apart from these three will be taxable under section 112. What will be tax rate? See, for normal resident individual, it will be 20% with indexation. 20% tax rate flat, but you will be allowed indexation if it is long-term capital gain, except for bonds, debentures, except for first proviso, or except for any other thing where indexation is not available. You will be allowed indexation, but you will be taxed at 20%. If you are trading on, if you are just listen, this is important point people tend to forget. LTCG on listed securities. Long-term capital gain on listed securities. Have you heard long-term capital gain on listed securities? Yes, sir. Long-term capital gain on listed securities was 112A. But it says STT not paid like debentures. Any listed securities on which we have not paid STT, like debentures, we do not pay STT. Debentures, we do not pay STT. For that matter, you have a choice to pay lower tax. For any debenture, for any securities that are listed but they do not fall under section 112A. Any listed securities like SME exchange, any securities on which we have not paid STT, but they are listed, we have an option to pay 20% with indexation or 10% without indexation, whichever is lower. Any securities that are listed, but STT is not paid. For example, debentures, for example, SME IPOs. Got this point? Any non-resident foreign company, for normal LTCG they have 20%, but when they are selling unlisted securities of a private limited company, they have an option to pay 10% tax without indexation. This is important point people tend to forget. This will be again covered in non-resident taxation, but I want you all to remember this thing from right now. What I said, any non-resident, any other LTCG will be taxable at 20%, but any sale of unlisted equity shares of an Indian company will be taxable at the rate of 10% without indexation. Did you get this point or not? Got sir, got sir. Notes for all the above section 111A, 112A and 112. Notes for all three sections. No deduction under chapter 6 will be allowed. Very basic point. No deduction will be allowed under these things. Sir, basic exemption limit will be allowed. Benefit of basic exemption limit will be allowed on these three assets. But remember, basic exemption limit is basic exemption limit benefit is only available for only resident individual and HUF. For non-resident, not available. For any other SSC like AOP, not available. You don't have to look for basic exemption limit for any other SSC except for residential or HUF, individual resident or HUF. If you want to mark this or if you want to highlight this, do highlight. Do not fear any way out. Sir, how things will be sorted? First, all the other income will be settled, and then this income will be used. For example, just have an example. Mr. Rahul has an income of 4,80,000 rupees. Out of such 4,80,000, 3 lakh rupees is LTCG under section 112A. Tax rate will be 20% for such income. LTCG under section 112 will be 1,20,000. So tax rate will be 10% over and above 1 lakh. That is 10% on 20,000 rupees. And normal income is 60,000 rupees. What is basic exemption limit for Rahul? If you are very much aware, for tax regime under section 115 BAC, for tax regime under section 115 BAC, for 115 BAC, basic exemption limit is 3 lakh rupees. Out of this basic exemption limit, first you have to set off the other income. So other income is 60,000. That means 60,000 will be completely set off against this. Now we have 2,40,000 rupees unexhausted basic exemption limit. 2,40,000 rupees unexhausted basic exemption limit we are left with. Now we have an option to set off this 3 lakh against this 2,40,000, or we have an option to set off 1,20,000. Which income according to you should be set off? Which income according to you should be set off? Right answer is the income which is taxable at a greater rate which should be set off. Directly can't I set off complete 112A against this? No sir, 60,000 will still remain. So okay, no problem. Rest remaining we can set off now. So remaining we'll pay tax. So reduce 2,40,000. So taxable income will be 60,000 at the rate 20%. And 20,000 into 10%, 12,000 and 2,000. Tax will be 14,000. 14,000 will be taxed. Sir, will rebate be allowed or not under these incomes? Ideally, rebate should be allowed. Rebate should be allowed. As per provisions of CA final curriculum, rebate under section 87A will be allowed against this specially taxed income. But ITR utility for this assessment has not provided any rebate for this specially taxed income. ITR utility has not allowed any rebate under section 87A for this specially taxed income under new tax regime under 115 BAC. But for your CA final curriculum, ICI has not notified yet that whether rebate under section 87A will be available in new tax regime for the specially taxed income. ICI has not notified. So we will be going with old curriculum. We will be allowing rebate for such income. We will be allowing rebate for any specially taxed income under 115 BS. For that matter, I'm not here to tell what real life things go, how real life things go. We do talk about those things in our regular batch or exam oriented batch, but this is power batch. Now I have to move a bit faster. I am time bound. I cannot do anything. I'm sorry for that. See, now security is held as stock in trade or capital asset. How will you classify and why will you classify whether securities are capital asset or stock in trade? Sir, if it is stock in trade, taxability will be in PGBP, it will be slab rate taxable. If they are held as capital asset, it will be taxed at concessional tax rate. So it is important not to classify. How will you classify? For classification, we have rules given by CBDT. We have guidelines given to assessing officer. For CBDT to general public and CBDT to AO, you have to consider these things. So treatment in the books of the assessee. If assessee treats such assets as capital asset, you have to treat it as capital asset. AO will treat it as capital asset. If assessee treat as stock in trade, AO will not argue. AO will treat it as stock in trade. As AO has to consider what treatment assessee has done over the period. So period of holding, if asset is being held for long term for 10 years, 5 years, 4 years, then you have to deem it as long term capital asset. You cannot charge it under stock in trade. So quantum of purchase and sales. Sir, if SSC is very frequent in buying and selling securities, it shall be deemed that he is treating such assets as stock in trade. Sir, his objective is to earn dividend, then it is capital asset. Normally, people who are long-term investors earn from dividend. Any person who holds such stock as stock in trade never wants to earn from dividend. They just want to earn from price fluctuations. Therefore, if a person who has an objective to earn dividend, for him it will be always capital asset. These are 4 things that according to CBDT will help in deciding whether it is capital asset or stock in trade. AO shall take into account the following points while deciding whether it is capital asset or stock in trade. AO shall consider first of all these 4 points. AO shall consider all these 4 points. Second thing, if SSC treats stock in trade, then AO will not treat as capital asset. Never ever will AO treat it as capital asset if SSC himself treats such assets as stock in trade. SSC treats such asset as stock in trade, AO will never ever interfere and say that it is capital asset. Got it? Correct. In case SSC holds listed shares for more than 12 months and SSC offers such income under capital gain, and AO shall not question unless stance has been changed by the SSC. SSC has a habit of holding shares for long term, greater than 12 months. He has listed shares. He offers income under capital gain head. Why will AO argue in such case? CBDT specifically says AO will not argue unless SSC himself changes the stance and treats such assets as stock in trade. If shares are listed, held for long term, SSC treating as capital asset, AO will not question unless such a stance is being changed by the SSC. These are the things that AO should consider while deciding whether such securities are held as stock in trade or capital asset. Sir, one thing is to be taken care of. Sir, unlisted shares, whenever sold, will be taxable under the head capital gain because it is assumed that unlisted shares are not publicly traded. It cannot be held as stock in trade. It is assumed. Normally, unlisted shares will always be taxable under the head capital gain, but in two cases, when genuineness of the transaction is questionable, or in case where transfer is made to issue, transfer is related to issue pertaining to lifting of corporate fee, when there is issue in back end of the functioning of the company, when issue relates to lifting of corporate fee, in that case such transfer of unlisted shares can be still treated as stock in trade. It can be converted from capital gain or capital asset to stock in trade. Got this point? Very simple point. Valuation to reference to valuation officer. In case FMV as per registered value, for example, my FMV for a property has been valued by a registered valuer. AO is not satisfied with the valuation made by the registered officer. AO is not satisfied with the valuation made by the registered valuer. Can he refer the case to valuation officer? Yes, he can do. In case of FMV other than registered valuer, in case where SSC himself declares such FMV, what AO can do, AO has to find out whether there is difference of more than whether difference is more than 15% or difference is more than 25,000, whichever is lower. If difference is more than these two, then in that case AO can refer the case to valuation officer. Or in any case where AO feels like he has to refer such case to evaluation officer, he can do. So all in all, he can refer anytime. He can refer anytime if he feels so. Now we have some extra points that to be taken care of. Sir, if land and building are two separate assets for capital gain, land or building are two separate assets. For example, I have a land which is 20 years old and I have a building that is constructed just a year back, and I sold both of them collectively for a consideration of 20 CR. I sold both of them for a consideration of 20 CR. So for that matter, capital gain arising on account of land will be long-term capital gain, and capital gain arising on account of building will be short-term capital gain, because the building is constructed for a year, for lesser than 2 years. Period of holding for building is lesser than 2 years, so building will be short-term capital gain. For that matter, you have to bifurcate this consideration into two parts. First part will be on based on the FMV of building and FMV on land. For example, sir, FMV of building is 10 CR or FMV of land is 30 CR. In that sense, bifurcation has to be done. Bifurcation will be 5 CR for the building and 5 CR for the building and 15 CR for land. That has to be taken care of. That means any sale made for land and building, where land was a long-term capital asset but building was short-term capital asset, for that matter, sale consideration is to be divided based on the FMV of land and building. I hope things are really very clear. We have a very small concept called side pocketing. What side pocketing says? For example, if a mutual fund has a AUM of 100 CR, 100 crores AUM, which is divided into 1 crore units of 100 each, 1 CR units of 100 each. Ultimately, 100 CR AUM. 80% are invested in equity shares. 80% are invested in the equity shares of good companies, and 20% are invested in some of the companies like Yes Bank, or some of the companies like Jet Airways, which are completely dead. Company in itself, this asset management company in itself knows that it will never be able to recognize it will never be able to realize such values. So what will happen? It will reduce the value of such NAV. These poor investments, these bad investments will reduce the value of the NAV. It will not reflect the true picture, or it will not reflect the true performance of such mutual fund. So what these AUMs does, what these asset management company does, they segregate this portfolio and treat it as separate NAV. Now, whenever you will be willing to buy such asset, your NAV will be 80 rupees. That will be of good investments. Any person willing to buy such assets will be away from such bad investments, and he will be having exposure to only good investments only. And these investments will be realized, these investments will be given to shareholders only when they are realized. This separation of bad portfolio is called segregated portfolio. Simple cost of total portfolio you have to take. For example, if I have, take this example now. Cost of acquisition, for example, I have 20,000 units of rupees 100 each. I have 20,000 units of 100 each. So whatever investment I have is nothing but 20 lakh rupees investment I have. NAV of the asset transferred in the segregated portfolio, NAV is transferred is nothing but 20 CR. NAV before segregation was 100 CR. So what will be my value of bad portfolio will be nothing but 4 lakh will be bad portfolio and 16 lakh will be good for portfolio. As simple as it can be. Value cost of acquisition for segregated portfolio we are calculating. Cost of acquisition of the total portfolio was 20 lakh rupees for me. I have 20,000 units of 100 each. I have 20,000 units of 100. Let us suppose 20,000 units of 100 is. That means I have investment of rupees. I have investment of rupees 20 lakh rupees. These 20 lakhs can be bifurcated into NAV of the asset transferred in segregated portfolio. NAV of asset transferred in segregated portfolio was 20 CR and NAV of the total portfolio before segregation was 100. NAV of the portfolio before segregation was 100. So can I say 20% of the assets are transferred? So can I say out of 20 lakh, 20% is bad investment? Can I say 4 lakh is bad investment? Right answer is yes, 4 lakh is bad investments and 16 lakh is good investment. Therefore, 4 lakh will be cost of acquisition for such segregated portfolio. I hope I was able to clear things up. I was able to clear things up. Just have a look where we are right now. Where we are right now. Tax rates, exempt transfer. Exempt transfer is to be done yet. Anything kept on hold will be done after exempt transfer. I'm always unwilling to do this exempt transfer at the last session, at the last part of the session, because it is a bit technical. Do you all want me to do this exempt transfer today itself or not? See, we do have a lot of time. We do have sufficient time. We do have 20 minutes right now left. Okay, let's do exempt transfer. We'll leave a few important topics. We'll do tomorrow. Let us do some important topics. Sir, exempt transfer. These section 47 prescribes a series of transactions which are in fact transfer as per the definition of the transfer, but they will be deemed to be exempt. No capital gain will be chargeable in that transfers. Even though list is very small, I have tried to make it very precise. I have tried to make it very precise to make every word count. Therefore, your focus has to be here. What I am saying, distribution of capital asset on total or partial partition of HUF. Distribution of capital asset on total or partial partition of HUF. Sir, when asset is being distributed by HUF to its members, in case of partial partition or complete partition, such distribution is exempt. Even if HUF and members are different people, but in case of partition, it will be completely treated as exempt transfer. There is no rocket science. Transfer of capital asset under gift will be exempt. For example, I gift my property to my sister. It will be exempt transfer. For example, I gift property to Shraddha Kapoor. It will be exempt transfer. Yes, sir, it will be exempt transfer. At least for me, it will be exempt transfer. But for Shraddha, it will be taxable under the head gift. IFRS. So any asset transferred under gift will be exempt transfer. But ESOP will not be exempt transfer because ESOP is not a gift. ESOP is the earning of their sweats, earning of their toils, earning of their bloods. Employees work hard, because of which they earn ESOPs. Therefore, it is not a gift. It will not be treated as exempt transfer. It will be a taxable transfer. Any transfer made under gift or will, any gift made, any will created will be an exempt transfer. Always it will be exempt transfer. At least for your attempt, it will be exempt transfer. The entry cases will be studied tomorrow. We will be studying entry cases tomorrow. Focus has to be here. But if any company has a subsidiary which is 100% subsidiary and an Indian company, if a company has a subsidiary, 100% subsidiary, and subsidiary is an Indian company, any transfer of capital asset between two such companies, 100 holding and 100% subsidiary, shall not be regarded as transfer. For example, if a holding company transfers any asset, for example, plant and machinery, building, any asset transfer will not be treated as transfer. But what if this company transfers stock in trade? So stock in trade is not a capital asset. Provision will not apply. Stock in trade is not a capital asset. Provision will not apply. In that case, it will be treated as transfer and PGP provisions will apply. PGP provisions will apply in that case. So two conditions are to be checked. The two conditions are to be checked in this regard. Whenever you are transferring, whenever this company is transferring any asset, any capital asset to such 100% Indian subsidiary, or the subsidiary is transferring any asset to the 100% parent company, from the date of the transfer, at least for 8 years, such 100% relationship should exist. At least from the date of the transfer till the end of the 8th year, this 100% parent subsidiary relation should subsist, should exist. Also, the person to whom such asset is transferred shall not convert such asset into stock in trade. For example, this parent company transfers a building to such subsidiary. Even though they have a 100% parent holding relationship for hundreds and hundreds of years, but what if this subsidiary converts such capital asset into stock in trade? It will be taxable. It will be taxable. This exempt transfer provision will revoke here. Two conditions are to be met. 100% relationship subsidiary parent has to be maintained throughout. And second thing that has to be checked is subsidiary company or the company which is transferee company. The company to whom asset is transferred shall not convert such capital asset into stock in trade. This is to be checked really, really well. This was transfer between parent company and subsidiary company. Focus here. We have a Rahul Private Limited merged with amalgamated with Pinky Private Limited. They turned Rahul Pinky Rapi Private Limited, I should say. Rapi PL. In this case, Rahul Private Limited, which is being amalgamated, is an amalgamating company. The company which is amalgamating company, and the company which turns out to be as a result of amalgamation is amalgamated company. Two terms have to be very clear. Amalgamating company which is getting amalgamated, and amalgamated company which is the resultant company. Sir, Rahul Private Limited is amalgamating with Pinky Private Limited. Can I say all the shares of Rahul Private Limited will be a part of Rahul Pinky Private Limited? Can I say all the shares of Rahul Private Limited will become shares, all the assets of Rahul Private Limited will become assets of Rahul Pinky Private Limited? Right answer is yes, all the asset will transfer. Don't such transfer of asset amount to transfer? Can I say transfer of such asset amount to transfer? Right answer is it shall amount to transfer, but provision says transfer of capital asset by amalgamating company to amalgamated company. If amalgamated company is Indian company, exempt transfer. Sir, Rahul is the shareholder in this Rahul Private Limited. Rahul is a shareholder. He was taken off. All his shares were taken off by the company. All his shares were taken off by the company, and he was allotted shares of Rapi Private Limited. He was allotted shares of Rapi Private Limited. All his shares were taken off, and he was allotted shares of Rapi Private Limited. Can I say extinguishment of his rights in the shares of the Rahul Private Limited amounts to transfer? And allotment of Rapi Private Limited shares, it can amount to any capital gain. Yes, sir, it can amount to capital gain, but such capital gain will be exempt. Provision says surrender of shares by the shareholders of the amalgamating company for receiving shares of the amalgamated company. Surrender of the shares by the shareholders of the amalgamating company for receiving shares of the amalgamated company will be exempt transfer. Next provision. Facebook. No, not Facebook. Rahul Private Limited. Facebook holds 70% shares of Rahul Private Limited. Facebook merged with Meta. Now, if you can see, shares of Rahul Private Limited are being transferred from Facebook to Meta. Can I say there is transfer of shares? There is transfer of shares. Sir, Facebook transfer of shares between two foreign companies. provision says in this regard, it will be treated as exempt transfer. Read after me. Transfer of shares of Indian company. Transfer of shares of Indian company in case of amalgamation between foreign companies. In case of amalgamation between foreign companies, will be exempt transfer, provided that at least 25% of the shareholders of the amalgamating company shall continue to be shareholders of the amalgamated company. At least 25% of the shareholders of the Facebook shall remain shareholders of the amalgamated company. This has to be taken care of. And last point is any transfer of capital asset in case of banking company with case of banking institution. For example, Vijaya Bank and Corporation Bank merges with Union Bank. In that case, any transfer of capital asset, if it is made as per Banking Regulation Act, it shall be completely exempt transfer. Did you get this point or not? Yes, sir, we did understand. We did understand. We got your point. Transfer in case of demerger. Sir, Reliance, and we have Geo Financial Services. Geo Financial Services is being demerged from Reliance. Geo Financial Services is being demerged from Reliance. What will be taxability of this transaction? What will be the taxability of this transaction? We'll understand one by one. Just listen to this. Sir, can I say shares of Reliance are assets of Reliance are being transferred to Geo Financial Services in consideration of the shares of such Geo Financial Services? Can I say shares of assets of Reliance are being transferred to Geo Financial Services in consideration for the shares of the Geo Financial Services? Can I say transfer of assets shall amount to capital transfer? Right answer is it is transfer, but it is exempt transfer. This is what the provision says. Transfer of capital asset by the demerged company to the resulting company shall be exempt transfer. Sir, what if Rahul is a shareholder of Reliance? He holds one share of rupees 3,000 each. His value is reduced to 2,700. And he's being allotted a share of Geo Financial Services whose value is 400. Can I say Rahul surrendered a part of his share? Rahul surrendered a part of his share to receive shares of a demerged company, resulting company. Can I say this amounts to a transfer? Right answer is again, this is a type of transfer because a part of your asset has been surrendered, a part of your asset has been extinguished to receive new asset. It amounts to transfer. Therefore, it shall also amount to transfer. But as per this provision, it will be exempt transfer. It will be exempt transfer. Same goes with last provision. Just focus here. Rahul Private Limited. Shares are held by Meta. Sir, what if Facebook got demerges from Meta? Facebook demerges from Meta. What will happen? All the assets of the Rahul Private Limited shall form part of the Facebook. Now what happens? Shares of Rahul Private Limited are being transferred from Meta to Facebook in case of demerger. Can I say this transfer is exempt transfer? Right answer is this transfer will also be exempt transfer. These are the cases of exempt transfer. What it says, transfer of shares of the Indian company or in case of demerger between foreign companies, at least 75% of the shareholders of the demerged company shall result in the shareholders of the resulting company. Got it? Okay, perfect. Redemption of sovereign gold bond by the SSC. What sovereign gold bond is, you are very much aware. To curb the need of the physical gold, government has introduced gold bonds. As the price of gold rises, same prices of gold bond rises. Even gold bond pays 2.5% interest on the face value. So this gives an additional benefit to the shareholders. Sir, if such gold bonds are being redeemed by the individual shareholder, then any capital gain arising shall be exempt. Can I say other than individual, if anybody is doing, will it be exempt? Right answer is no, only done by individual is exempt, not anybody else. Can I say indexation will be available? Right answer is yes, indexation will be available. What if an individual sells such sovereign gold bonds before maturity? Can I say capital gain will be leviable? Right answer is yes, capital gain will be taxable in his hands because this exemption is available only at the time of redemption. And what about, sir, interest? Interest taxable or exempt? Right answer is interest is also taxable. Sir, we are getting confused. Can we have a chart for this? You asked for a chart and I cannot present. How is that possible? Sovereign gold bonds. Individual. Redemption on maturity, no capital gain under section 47. Transfer before maturity, capital gain applies and indexation is allowed. Other SSCs, capital gain On transfer, maturity, indexation available. Capital gain on the transfer, on the maturity, and indexation available, and interest is always taxable. Whatever you think of will be available in this book. We have transfer of capital asset under reverse mortgage scheme. For example, what happens is reverse mortgage scheme is very popular in old age people. For example, if a parent does not have any children or all of their children are studying abroad, what happens is they have a house. They lend such house to bank, and against such lending, they get every month installment, every month payment. What I'm saying, just understand this with an example. Rahul is nearly 70 years of age, living alone, nobody in the family. He has a house, but he wants every month income. What will he do of this house after his death? He wants income now. When he's living, he wants income. After his death, what will we do of this house? So he gave this house to bank. Not just gave, he just gave virtual possession. He gave the keys, or he gave the power of attorney that whenever I'll die, this property will lie upon you. This property will be yours. Against such property, bank gives him monthly installment of, say, for example, 30,000, 40,000, 50,000, 50,000. Can I say it is a kind of reverse mortgage? Because I am not giving any month, I am not getting any lump sum installment against which I am required to pay everything. I am getting every month installment. This is called reverse mortgage scheme. In this transaction, any transfer made by such senior citizen to this bank will be exempt transfer. Every monthly installment received by such senior citizen will be also exempt. And last but not the least, any sale by such bank of that house will be taxable, and cost of acquisition will be every monthly installment paid to such person will be taxable, will be cost of acquisition. I hope you got what I am trying to say. I guess that's it from my side, because we are already exceeding some time. We are exceeding time, and the topics are a bit technical today. So from tomorrow onwards, I guess it will take half an hour for us to complete this topic. And from that, we'll start IFOS, and most probably we'll be starting PGBP also. From now onwards, you are in a position that you can solve every question. Each and every question is uploaded on YouTube. At least of this chapter, it is uploaded. It is in Hindi, but it will give you a good reference for understanding purpose. How to solve, how to approach, how to do things. Did you get this point? You have to solve all these questions. If you have any doubt, just contact me. I'll be there for you. Till then, take care, enjoy studying. See you guys tomorrow with same energy, same optimism, and same broad smile looking at me. Take care. Bye bye.